Hello, everyone. Welcome to the S Corporation Deep Dive webinar. So today we're going to be going over some advanced topics with regards to S Corporations. Before you watch this webinar, I'm going to assume that you've already watched the webinar on S Corporation Basics that I go over in the webinars for part 2. Okay, so watch that webinar first before you watch this one. All right. Now, S corporations in general. An S corporation is a corporation or other qualifying entity. Okay. You got to start with something first, and it's either going to be a corporation or an LLC, usually, or it can also be another qualifying entity. And I'm going to go over what those can possibly be. But generally, you're going to start with a corporation at the state level, form a corporation, or you're going to form something like an LLC. And then the S corporation is an election. An S corporation is never formed. You don't form an S corporation. You form something else, and then the S corporation is a tax election. You're electing to be taxed as a pass-through entity. That's what an S corporation is. Okay. Now, with an S corporation, the income, losses, deductions, and credits flow through to the shareholders on a pro rata basis. Okay, that's actually one of the big drawbacks of an S corporation. Not the fact that it's a flow-through entity or a pass-through entity, but the fact that the income, losses, deductions, credits, etc., have to be passed through on a pro rata basis, which means based on the shareholder's ownership stake. Partnerships are allowed a lot more flexibility in that regard. And even C corporations in that regard are more, let's not say flexible, but they have more option. Because a C corporation can have common stock and preferred stock, and they can also have multiple types of common stock and preferred stock. So certain shareholders can be paid more, certain shareholders can be paid less, certain shareholders can be paid first. They can have different rights to dissolution proceeds and all of that. A C corporation can do that, and an S corporation cannot. An S corporation can only have one type of stock, and the stock can only have differences in voting rights. That's the only difference that the stock can have. Okay, so with that regard, S corporations are more inflexible than partnerships and C corporations. Now, IRS approval is required for the S election status. Most states will just accept the IRS or the federal S corporation election, but some states require a separate state level S corp approval or filing. I've never practiced in a state that does. I think New Jersey is one and New York is another. There's 3 or 4. It's not very many. But just understand that there are some states where you have to file a state level S election. Okay, and I'm not going to discuss state level S elections because I don't have any experience in practicing in a state where a state election is necessary. So I've only ever lived in California and Nevada, and California doesn't have a state level election, and Nevada has no corporate income tax. You don't even file corporate returns in Nevada. So the IRS approval is required for the S election status, and most states do not have a separate S election, but a few states do. I just want you to realize that. Okay, there's a couple of oddballs out there. Now, the S corporation has a maximum of 100 shareholders. You should know that by now. Family members can be counted as one shareholder. And for this shareholder limit, it also includes a situation where, for example, you have a married couple and then one spouse dies. Then the estate of that deceased spouse and the survivor can still be considered one shareholder for the purposes of this shareholder limit. So you might have a situation where the S Corp itself has a maximum of 100 shareholders, but some of these might actually be entire families, where you have the a spouse, a husband and wife, let's say, and then there's children and everything. And those people will be counted as a single shareholder, and each one of those people will be getting a separate Schedule K1. So the S Corp the S Corp itself will have technically 100 shareholders, but there'll be more than 100 Schedule K1s because you have family members being counted as one shareholder. So that's possible. Okay, I personally have never done an S Corp that large, but they exist. Okay, and I want you to understand the semantics of that. So maximum is 100 shareholders, but family members can be counted as a single shareholder. So you can have like a husband and wife, their son, their daughter, all counted as one shareholder for the purposes of this limit. Now, S corporation shareholders are restricted. What this means is that only certain types of persons and entities are allowed to be shareholders in an S corporation. Okay, and I'm going to show you the list of permitted shareholders. All right, so here I am on the Taxbook web library, and this is through my NATP membership. I have a premium membership through NATP. The premium membership through NATP is a little bit pricey. I know it's like kind of spendy, but I find that it's really useful because you get the Taxbook web library basically for free with your premium membership. It's one of the perks. And NATP has a lot of good CPE. And once you do the premium membership, it's unlimited. Okay. So I just want you to realize this as well. Anything that I recommend to you as a resource, I'm not getting any kind of kickbacks or affiliate fees or money or anything. If I recommend something to you, it's because I've used it and I like it and it works for me. I'm not telling you what to do with your own practice or how to spend your own money. I'm just telling you what I use. I want you to understand that I have multiple resources that I like, and there are certain things that I don't like. If I tell you something that I don't like, then it's usually because I have specific experience with it. Looking at you, Intuit, I'm not going to give you my driver's license information or my social security number or my date of birth so I can get into my desktop file, Intuit. QuickBooks, they started doing that this year. Now you have to log in to their stupid website every single time in order to use the QuickBooks desktop software. So I'm looking for an alternative, and I'm going to test drive Sage next week, but I'm pissed off about that. The pop-up came up and they're asking me for my social security number and date of birth. I'm not giving that to you, Intuit. I'm not. You can suck it. All right. Anyway, so I use the Taxbook web library. I like it. I've used the Quick Finder before. I've also used Parker. I feel like the Taxbook web library has the best search function. Like if I search for something, it'll come right up. All right, that's just my personal opinion. Nobody's paying me to say this. This is what I use and I like it. Okay, so Taxbook web library, if you look up S corporations, it tells you about the S corporation advantages and disadvantages, right? The penalties are nuts for late filing S corporations. $280 penalty for each failure to timely issue a Schedule K1, because the penalties keep going up every single year. The C corporations are not like this, by the way. I want you to understand. With partnerships and S corporations, they're pass-throughs, right? In general, an S corporation doesn't pay income tax. There are only very rare situations where an S corporation would pay income tax, and that generally only happens when it was a C corporation in the past, and then it converted to an S corporation. It still has stuff going on from when it was a C corporation, right? So it's unusual, let's say. It's unusual for an S corporation to pay income tax. So when the IRS assesses penalties against an S corporation, they do it for late filing. That's the same with partnerships. So partnerships, it's a pass-through, right? Partnerships don't pay income tax. All of the income loss, all the activity is passed through on the Schedule K1 to the individual partners. But where you have these nightmarish penalty scenarios is when a person comes into you and they have a partnership or an S corp and they haven't filed for 2 or 3 years or even 1 year, and the penalties for late filing are going to be thousands upon thousands of dollars. So that's why I don't do delinquents anymore. But there's a way to mitigate this. And my suggestion is if you have an S corporation, it's like you always file an extension. Always file an extension. Okay, partnerships too. Always file an extension. Just to make sure. They're due March 15th. That's the filing deadline for S corporations and for partnerships. You always have to make sure that you file an extension if you're not sure that you can make that March 15th deadline. So that applies to S corporations and partnerships as well. If you don't think you can make that tax return filing by March 15th, get it in by that date, then you got to file an extension. All right, because it's the late filing penalties that'll kill you. Now, I want you to understand the difference between S corp, partnership, and C corp filings in this regard. Corporations are always required to file a tax return. If you have a C corp or if you have an S corp, corporations have a filing requirement every single year that they exist until they actually formally dissolve. All right, they have a filing requirement until dissolution. Now, partnerships and sole proprietorships are not like that. If a sole proprietorship has no activity, you're not going to file a Schedule C with just a 0 on it, right? So sole proprietorships that have no activity, you don't file a Schedule C for that sole prop, right? That doesn't make any, you wouldn't do that. That wouldn't make any sense, right? So let's say I sold Avon, right? Direct seller, that's easy. Let's say I sold Avon or Mary Kay or something like that. I was direct seller, and I did it last year, but I didn't have any sales this year, and I just took a break, right? I was taking a break from my business. Then I could not file a Schedule C this year because I had no sales or no activity, took a break, whatever. And then next year I could start back up again, and that would be fine. And then I could file a Schedule C next year, right? That's what you would do. Now, the same holds true for partnerships, although there's no level of activity for a partnership where you wouldn't have to file a partnership tax return. By that, I mean, what it says in the IRS publications is that a partnership must have no activity, which means 0 activity. Not that partnership didn't even make $1, all right? Then in that case, the partnership doesn't have to file a tax return. If a partnership has no activity, $0 of income or loss. Now, that doesn't mean that you won't get a notice, all right? The IRS, if you've requested an EIN for a partnership, then there's a very good chance that the IRS will send you a notice and say, where's your tax return? Now, if the partnership genuinely had no activity, like the partnership just requested an EIN, was just formed, but there's 0 activity, 0 income, 0 loss, business hasn't even started, then if you get a notice from the IRS, there'll be a box on that notice. I've seen them before, but it's been a few years since I've seen one, where it says this partnership had no activity and therefore did not have a filing requirement. You just check that box. Okay. But, if there's a 1099 out there with the partnership, like allocating income to the partnership, that the partnership earned, $10 of interest or, had, $100 in sales somewhere or whatever. If there's a transaction statement floating around there, an information statement issued to the partnership, then all bets are off. The IRS is going to want to see a tax return for that partnership. Okay. So when I say that a partnership doesn't have to file a tax return if it has 0 activity, I really mean 0. No income, no expenses, no losses, no nothing. No 1099s floating out there for the partnership. All right. 0 activity means 0 activity. Then the partnership legitimately does not have a filing requirement. Okay? Okay. Now, S corps always have a filing requirement. Even if there's 0 activity, you have to file an S corp return. All right? And if the S corp return is late, the IRS will issue penalties for the late filing. Even if the S Corp has losses, if the tax return goes in late, then the IRS is going to assess a penalty. Let's get back to what I was talking about. I go off on tangents. I know, I'm sorry. I always got like another tidbit that I got to give you. But let's get down to the eligible shareholders, which is the whole reason why I came to this website in the first place. Okay. So in your practice, most of the time what you're going to see is an S corporation and the shareholders are all natural persons. Okay. Natural person is a human being. It's a person. Okay. You're a natural person. I'm a natural person. We're humans. Now, not all natural persons can be shareholders in an S Corp because non-resident aliens cannot be shareholders in an S Corp. All right. Only individuals who are U.S. citizens or U.S. residents. Okay. Non-resident aliens cannot be shareholders in an S Corp. Now, there is a narrow exception to that. It is possible for a non-resident alien to hold shares indirectly in an S Corp through an electing small business trust. I personally have never seen that. This is like lawyer territory, but technically it's possible. And the person who actually even told me about this was Joel Bush, who is one of the co-authors on the Passkey books, and he's a lawyer. So of course he would know, that this was possible, but a non-resident alien cannot hold shares in an S Corp directly. Okay, let's just put it that way. So individual shareholders that are shareholders in S Corp have to be U.S. citizens or U.S. residents. The rest on this list you're going to see less often than just individual humans. Okay, a decedent's estate can be a shareholder. So if a person is a shareholder in an S Corp and then they die and the stock passes to the estate, then that will not terminate the S election. It's not a terminating event. Bankruptcy estates are also eligible shareholders. 501c3 charitable organization. Now, this is the only situation where you can have a corporation that owns shares, a C Corp that owns shares in an S Corp. And that's if the corporation itself is a 501c3. Okay, so a 501c3 is the only type of C corporation that can own shares in an S corporation. Now, the same doesn't hold true in reverse. So an S corporation is allowed to invest. So my S corporation, let's say my S corporation could invest in stock and buy Apple stock or Ford stock or Tesla stock, anything like that. S corporations can invest. They can buy partnership interests, and they can also invest in publicly traded stock, and that's perfectly fine. But the same doesn't hold true in reverse. So a partnership cannot be an S Corp shareholder, and a C Corp cannot be an S Corp shareholder unless that C corporation is actually a charitable organization organized under 501c3. Okay? All right. A qualified subchapter S trust. So there are certain types of trusts that can be shareholders in an S corporation. So qualified subchapter S trust, a QSST, an electing small business trust, which is an ESBT, an employee stock option plan can be an eligible shareholder in an S corporation, and then a qualified pension and profit sharing plan. Okay, so an S corporation can have all of these eligible shareholders. And most of the time, like I said, what you're going to see is individual humans who are U.S. citizens or U.S. residents. They're shareholders, natural persons. Okay, but all of these would be eligible shareholders in an S corporation. Okay, now, ineligible shareholders. Non-resident aliens cannot be shareholders in an S corporation. A foreign trust cannot be. C corporations, with the exception, once again, of 501c3s. Okay, so a for-profit C corporation, a C corporation that is organized for profit, like most C corporations are, cannot be a shareholder in an S corporation. If they do acquire shares in an S corporation, then that S corporation ceases to be an S corporation on that date. Okay, and then it's taxed as a C corporation from that day forward. Partnership, a charitable remainder trust, IRAs, an IRA cannot be a shareholder in an S corporation. And then an LLC and an LLP cannot be shareholders in an S corporation, with the exception of a single member LLC that is treated as a disregarded entity. So technically, this is not in the Internal Revenue Code, by the way. I think this is actually a PLR. Don't quote me on that. It's either a PLR or a chief counsel advice. It's something like that. It's floating out there somewhere. I've actually read it. If you have a single member LLC that is disregarded, then the disregarded single member LLC can own S corporation shares if it's a disregarded single member LLC. But if it's an LLC, if it's a multi-member LLC, then that's a partnership, right? Okay, so if you have a multi-member LLC that's taxed as a partnership or any other type of partnership, then those entities cannot be shareholders in an S corp. Now, an S corporation can own another S corporation, okay? An S corporation can wholly own another S corporation, which means my S corporation could own 100% of another S corporation. That's the only way that one S corporation can own stock in another S corporation. It has to be wholly owned, 100%. And I've seen other tax practitioners ask, like, why would you do this? Why would you have a situation where you have an S corp, you have one big S corp at the top, right? And all these little S corps on the bottom that are all wholly owned. They're all 100% owned by the big S corporation at the top. And the short answer for that is that it's usually done for legal reasons, right? So to limit the liability of the parent company, maybe you have a situation where it is a company like In-N-Out. Let's say you own a restaurant chain and you're the only shareholder, but your restaurants are really popular. And now you have 10 restaurants, right? Let's say. And restaurants are doing really good. You're making millions of dollars. It's very successful. So you have a lot to lose, right? So you're going to want to form a separate corporation for each restaurant. And then if one of them has some catastrophic event, right? Somebody slips and falls and dies inside your restaurant, or one of the cooks gets killed in the fryer or gets locked in the freezer overnight, and then you get up in the morning and then you find out that your head chef is a block of ice frozen to death in your walk-in freezer, and now the family wants to sue the pants off you, right? Right. So what happens is, most of the time, if you have a restaurant chain like that, or any kind of business where you have multiple locations, most of the time, each one of those locations is going to be either in a separate LLC or in a separate corporation. They do that for legal reasons, all right, to protect the parent corporation in case you have some kind of a huge lawsuit potential. I mean, I'm not going to discuss any of the legal issues because I'm not a lawyer, but I have worked in the restaurant industry when I was a lot younger, before I became a bookkeeper or an accountant. And I do know that I did work for a chain that was franchised, and I know for a fact that each one of the restaurants in that chain were a separate LLC. All right, so I know that it gets done for legal reasons. It is permitted. So you can have an S corporation that owns another S corporation, but if they do own that other S corporation, it has to be wholly owned. Now, if by some chance you have an S corporation and it acquires another S corporation but doesn't acquire all the stock, it acquires, let's say, 50%. Then what ends up happening is that's a terminating event for the subsidiary, and that subsidiary will be treated as a C corporation. So like I said, an S corporation can own shares in a C corporation. So an S corporation can own a C corporation. That's perfectly fine. But if an S corporation attempts to acquire another S corporation and then flubs it somehow, doesn't acquire all of the stock, or doesn't do the election correctly, then what will happen is the IRS will treat that subsidiary as a C Corp and not an S Corp. So S Corp can own another S Corp, but only if they own 100% of it. Okay? All right. Now, back to our slides. So as I mentioned, an S corporation is never formed. An S corporation is a tax election only. The underlying entity is never going to be an S corporation, right? So you're going to have a corporation or you're going to have an LLC, and then you're going to make a tax election only. The underlying entity doesn't change because of this S election. Okay, you're treated as an S corporation for tax purposes only. But for legal purposes, the underlying entity stays the same. So if it's an LLC, a limited liability company, that makes an S election, sends in the 2553, and elects to be taxed as an S corporation, it's still an LLC at the state level. Just for tax purposes, the IRS treats it as an S corporation. S corporation is a tax election only. It's not a legal entity type. Okay, so S corporation is never formed. It's an election only. Now, a for-profit corporation formed at the state level can elect S status by filing Form 2553. And I'll explain what I mean by this. Okay, so a for-profit corporation formed at the state level can elect S status by filing Form 2553. A corporation, if you form a C corporation at the state level, the corporation only has two choices. It's a C Corp by default, or the corporation can file a Form 2553 and elect to be taxed as an S corporation. A corporation cannot make any other entity selections. And I thought that this was obvious, but I'm in a Facebook group where another tax practitioner, and I think she was actually an enrolled agent, actually asked this question. Like, she had a client come in that was a C corporation, and she said, I want to file a Form 8832 for this corporation to be taxed as a partnership. That's not possible. A corporation is a corporation, and that's it. So it's got two choices. If you form a corporation at the state level, it's a C Corp or it's an S Corp, and that's all it is. You can't be a corporation and then be taxed as a sole proprietor or a partnership. That's not how it works. A corporation is a corporation. That's it. Okay? Now, an LLC, which is a limited liability company, is a little more flexible. So an LLC or a PLLC can also elect S status. PLLC is a professional limited liability company. And this is a situation where you have a company that's offering professional services. Most states do not allow a professional services firm to be an LLC. At least in California, that's the case. Professional services firms cannot operate as LLCs in California. And California does not offer the option of a PLLC, which many other states do, but not all states. So if it's a professional services firm and they want to do business in California, then they have two choices. They have the choice of forming an actual corporation, not an LLC, or they can form an LLP or an LP, depending on what their lawyer recommends, basically, because These are questions for an attorney. So an LLC or a PLLC, each one of those entity types can also elect S status by filing Form 2553. Now, I personally have done S elections for corporations, and I've also done S elections for LLCs. I have never done an S election for any other entity type, but it's possible to do an S election for an LLP or an LP. And many tax practitioners don't know that. Now, I do have a link here, which is an example to an old PLR. So this is an old PLR from 2003, which is almost 20 years ago. And it's an example of a LLP that has requested S status late. And in that particular scenario, the LLP requested late election relief, and it was granted by the IRS. So I wanted to give you an example where it was actual IRS advice, where the IRS granted an LLP late election relief to be taxed as an S corporation. And in this PLR, it's a limited liability partnership that made the election. Now, this is an old PLR. So in the PLR, that limited liability partnership would have had to file the 8832 first, and then the 2553, which was the old procedure. And now that's not how you do it anymore. If you have a qualifying entity like an LLC or a PLLC or a corporation or even an LLP, and that entity wants to be taxed as an S corporation, the only thing that they have to file is the 2553. So the old procedure was that if you had an LLC or anything other than a corporation, that entity would have to file the 8832 first to be taxed as a corporation, and then file the 2553 to be taxed as an S corporation. So they had to do two steps, and now there's only one step. Okay, all right. Now, if you want more information about this, about the whole entity choice thing, I'm going to give you some resources that are actually free. So here I am on the website for CPA Academy. Not affiliated with CPA Academy except as a customer. All right, so they offer lots of free courses, tons of free courses, as well as paid courses. And I've taken their free courses as well as their paid courses. I also use several other CPE providers. So this is not the only CPE provider that I use personally, but I do like to recommend CPA Academy to new preparers because they offer tons of free courses that qualify as CE for enrolled agents. And I know at the very beginning of your career, sometimes money is really tight. Now, Passkey has a free CPE mailing list as well. You can sign up on the footer of our website, where we just send out information about free courses. I'm not trying to sell anything to you. I'm just trying to help you become an enrolled agent and get your CE that's required every single year, because you can't skip It's all the CE providers, they report your CE to your PTIN account. So the IRS knows if you haven't done your required CE. And actually, this year, the IRS audited my CE. I had to send in proof that I got all of my required CE, including ethics courses every single year. So we talk about this in part 3 webinars, and the webinars for part 3, what the requirements are for an enrolled agent, your annual CE requirements. You have to make sure you get your CE. And the reason I recommend our mailing list as well as CPA Academy is because this is one of the few resources I know out there where you can get CPE for free. Now, that if you're going to put in your email, right, and you have to put in your email in order for them to contact you about the courses and also give you your certificate. And they're going to give your email out to these companies, right? So the courses are free, but they're going to market to you. All right, I'm warning you that if you want it for free, that you know the email that you put into this website, they're going to send you junk. Now, as I said, I'm not affiliated with CPA Academy. I'm just telling you, I've used them. I've used them for several years. And I've purchased the paid courses on here, as well as I've listened to many of the free courses. And some of them are boring and not very good, but some of them are really good. So this is one of the instructors from CPA Academy, and I don't know him. I'm not affiliated with anybody on this website, but Steve Gorin is one of the instructors that talks about this type of entity selection, where you can have an LLP or an LP and make an S election. And it was one of his classes that I listened to where I learned that this was actually possible. Once again, his name is Steve Gorin, CPA, and he's also a doctor of law. He has a JD, and you can search for his name, but this is one of the courses, and it's archived, so you can listen to it, and it's free. Business opportunity, substance over form, and unincorporated entities as an S Corp. So he talks about this particular subject, and he does other classes too. There's a lot of really great instructors on this website, and even Annette Nellen occasionally teaches courses on CPA Academy, and she's fantastic. She's my favorite CPE instructor in the world. She's so fantastic. She's the dean of the accounting department at San Jose State University, and I always try to get onto her courses when they're offered. When Annette Nellen offers courses, she also offers them through Cal CPA, but they're super spendy, like $700 for a 2-day course. So compared to free, obviously, that's a lot. It's a lot more expensive, right? Right. Okay. So this CPA Academy is a great resource if you want to learn about this stuff, and this particular instructor does talk about entity selection. He also teaches a lot of classes on trusts, if that's an area of tax law that you'd like to know more about too. All right, so let's go back to our slides. And I'm going to talk to you right now about the late filing penalties for an S corporation. Now, late filing penalties apply to S corporations as well as partnerships. And since they're pass-through entities, the late filing penalties for both of these types of entities apply to the number of months that the return is late, as well as the number of shareholders or partners that either one of those entities have. And the more shareholders the S Corp has, the more late penalties the IRS is going to pile on. And they're assessed every single month that the return is late. Okay. And the only way to really mitigate these penalties is to file on time. And if you can't file by the original filing deadline, you need to file an extension. And if you file an extension and for some reason you have to file on paper, which actually does happen pretty often, especially when an S corporation is new, because if the extension goes in and you're trying to e-file it, for example, is what I'm trying to explain. Let's say you have a multi-member LLC that wants to elect to be an S corporation, and the 2553 has not been processed by the IRS yet, the S Corp election. Sometimes you have to file the extension on paper because you'll get a reject when you try to e-file. That's when you really have to keep on top of things, because you have to make sure that the IRS processes that 2553 and that you get the notice of acceptance. The notice of acceptance is the letter that you get from the IRS that says, yes, your S Corp election has been approved. All right, and there's a date on there that says from this date, basically. Now, and I'm going to talk about that, situations where you end up with a dumpster fire because the CPA or the EA or the tax practitioner didn't stay on top of things and make sure that 2553 got processed. The IRS many times won't send you a letter for years, and it'll seem like the S Corp return is being accepted and it's not being processed at all on the IRS side because the IRS doesn't have the correct entity type. Or, well, you don't have the correct entity type, because basically what the IRS says goes. And if you don't have that notice of acceptance, then there's a chance that S Corp election has never been approved by the IRS. I'm going to talk about that because there's tons of horror stories in the Facebook groups about that sort of thing. This is separate. Right now, I'm just talking about late filing penalties. Okay, so you got to make sure that if you can't file the S Corp return by the due date, which is March 15th for 99.9% of all S Corps, I know there's fiscal year S Corps out there, but for the most part, S Corps file on a calendar year. Almost all of them. And if they file on a calendar year, then the due date is March 15th, and you can request an extension. And most of the time, that's what I do. It's rare that I file any S Corps or even partnership returns by March 15th. It's just too early. So I almost always file an extension, and I always make sure that I get the electronic postmark on that extension too. You have to verify it. All right, in your software. If you don't get that electronic postmark, the acknowledgement from the IRS that extension has been accepted, you need to make sure that you file the extension on paper. I mean, worry about the reasons why later. File that extension on paper. Do it certified mail. Pay the $3 because that $3 can really save your bacon later. It has for me on more than one occasion. Whenever I have something time sensitive, it always goes certified mail. And that doesn't mean you necessarily have to stand in line. This is a tip from me to you. You can buy cheap labels on Amazon. Let me show you what they look like. So this is what they look like, the Avery ones. Avery makes them, but they're a little bit more spendy if it's Avery. And it's one sheet, all right? Like it looks like this, okay? But then there's two labels on there, and they're already like, there's like a little cut in the middle. You can't see it, obviously. This just looks like a piece of paper, but it's two labels, all right? And then Amazon has them really cheap, like this. It's 5 by 8.5 labels, and then the sheet looks like this, right? You could just put it in your printer through the feeder, and see, it peels off like that. Okay, so this is what I use. I buy these super cheap on Amazon. They're like $10 for 500 or 200 or something like that. I buy them like once a year maybe. And if I have something that has to go time sensitive, either a return that's like due tomorrow, right? Or you're right at October 15th, you got to file a return, you get a reject, you get an e-file reject, or for some reason it has to go on paper because there's attachments, then that's what I do. And I go to the USPS website. I don't use a third party website. USPS is the official US Postal Service website. And it's a little bit clunky to use, I think. But I always print the label from there because there are several cases from the U.S. Tax Court where the U.S. Tax Court did not accept third third-party labels, like labels that were printed by a third party like stamps.com or Pitney Bowes or whatever. So I always print from the USPS website if I don't actually go to the post office, which is rare. Usually I don't want to go stand in line there. And then I just, I have those like big manila envelopes and I print directly from USPS.com, and then I make sure that I send the taxpayer down to the post office, or I'll go if it's something for one of my companies, right? If it's something for me, then I'll go and I'll make sure that that label gets scanned. If it's something that's really time sensitive, and you could print the certified mail labels off of the USPS website, and you don't have to stand in line at the post office in order to do that. So it's really nice. And if your time's valuable, like mine is, right? I don't want to be standing in line, but I also want to make sure that if something happens and that package is delayed or something like that, that I have proof that it was mailed, number one, and that it's an official U.S. Postal Service label, okay? Because especially if it's something that's due like tomorrow, like you have an individual return that has to go in on paper for some reason, and it's right on October 15th, right? It's the extended due date, then, got to make sure that goes in certified mail. Absolutely. So always file an extension by the deadline. If you get an e-file reject on the extension because of incorrect entity type, send by mail. Always send certified mail. Always, always, always. Spend the $3. That $3 can save you thousands later. It has saved me on more than one occasion. That certified mail label. That is the proof of mailing. Now, this advice is also going to apply if you get another type of e-file reject. For example, if you get an e-file reject where it's a person who's the victim of identity theft, has to go in on paper, right? Has to go in on paper with an ID theft affidavit form. If that happens and you're forced to paper file, once again, you want to make sure that it goes in certified mail, all right, by the deadline. And that way the taxpayer will be protected from late filing penalties. And then when it comes to entities, just so you know, sometimes you'll have to e-file on paper and it will still be considered on time even after the deadline if the taxpayers are in a federally declared disaster area. And let me show you the IRS page for that, and I'm going to give you the details based on a recent disaster so you can kind of understand how this works. So we've had lots of disasters in the last few years. Unless you've been living under a rock, you know that that's true. And let's say you have an S corporation that filed an extension or didn't file an extension, and they were hit by a disaster, or the owners of the S corporation or the business itself is in a federally declared disaster area. All right. And what ends up happening is, let's take a recent one. This is tax relief for North Carolina victims of remnants of Tropical Storm Fred. All right. And you saw this list, right? This list is nuts. Look at all this. This is crazy. This is just 2021, right? And the year's not even over. These are all FEMA disasters where taxpayers and businesses in these areas have been offered some type of tax relief. That's why it's here on the website. So this is a recent one, and this was just updated on October 4th. And so it says Tropical Storm Fred and so victims in these particular counties, it always tells you the counties, individuals and households affected by remnants of Tropical Storm Fred that reside or have a business in these counties will qualify for tax relief. So you're considered an affected taxpayer. I'll put that in quotes. You're considered an affected taxpayer if you live in one of these counties, right, in one of the affected counties, or if you have a business in one of these affected counties. Now, the reason why it's really important to realize this is because sometimes you'll have a person that doesn't live in one of these affected counties, but they're still considered an affected taxpayer because maybe their business is in one of those affected counties, or they're just maybe even a partner in a partnership, even an investor where they're not actually working in the business, but they have to wait for the Schedule K1, and the partnership itself is in one of these disaster areas. In that case, that taxpayer, it gets automatic relief. But the IRS computers are not sophisticated enough to know every taxpayer that's affected. The IRS computers go off of the taxpayer's zip code in order to basically calculate the penalties potentially on the tax return. And if you have a person who does have a business or is an affected taxpayer, like maybe they're a partner in a partnership or a shareholder in an S Corp, where the entity itself is located in one of these areas, but maybe they don't live in one of these areas. Maybe they live in a neighboring county that's not one of the listed counties, but their business is in an affected county. Then that taxpayer is allowed relief as well. They should not be assessed penalties for late filing if they follow, the extended relief deadline. So in this particular case, this is Tropical Storm Fred, and the IRS has announced that these taxpayers get until December 15th of 2021 to file their tax returns. So this means that individuals who had a valid extension to file their 2020 returns due to run out on October 15th will now have until December 15th to file. And that includes businesses with extensions also have additional time, including, among others, calendar year partnerships and S corporations whose 2020 extensions ran out on September 15th. Okay, because the disaster basically began on August 16th, which is before the extended deadline. So if you had an S corporation that filed an extension and then was affected by this disaster and ended up having to file late, or just filed late, but you know that this person was in an affected county, I know that people get discombobulated. That doesn't necessarily mean that your business has to be destroyed or you have to have like some kind of disaster affect you personally. All right. I want you to understand that the people in these counties get extra time to file. The IRS has already stated that they're in FEMA disaster zone. So if you get a client that comes into you and they're in one of these affected counties, then you can say, well, you're allowed to file before December 15th, and your return will still be considered timely. All right, so you got to know about this stuff because sometimes you can save your taxpayer thousands of dollars simply by being knowledgeable in this area. So let's say you have an S corp and you are in North Carolina. I want to get this right. Let's say you have an S corp, it's on extension, and they're in Transylvania County. Okay, so really there's a Transylvania County in North Carolina that was affected by Tropical Storm Fred. All right, so if you're in Transylvania County, North Carolina, you get until December 15th of 2021 to file your S Corp return, assuming you are on extension. Right? So my suggestion when you have a situation like this is if you know the taxpayer is an infected county and they're technically filing late, but they're not filing late because they get a disaster relief extension because of the county that they're in. If, for example, you're filing beyond September 15th, which is the deadline for S Corps that are on extension, right? That's the extended due date for partnerships and S Corps. But you're in an affected county and you're filing the tax return late, but it's still considered on time because you have a disaster relief extension that applies to your particular area. My suggestion is to file on paper, certified mail, and you write North Carolina remnants of Tropical Storm Fred in bold letters on the top of the return. This has been the procedure for decades. This is what you're supposed to do in a disaster area. Apparently, if you do e-file, sometimes the IRS will still catch it. But I have never had hello everyone. Well, and then it goes, it's going to vary. And it's a disaster. Dollars in one of these areas. The taxpayer is an infected county and they're technically filing late, but they're not filing late because they get a disaster relief extension because of the county that they're in. If, for example, you're filing beyond September 15th, which is the deadline for S Corps that are on extension, right? That's the extended due date for partnerships and S Corps. But you're in an affected county and you're filing the tax return late, but it's still considered on time because you have a disaster relief extension that applies to your particular area. My suggestion is to file on paper, certified mail, and you write North Carolina remnants of Tropical Storm Fred in bold letters on the top of the return. This has been the procedure for decades. This is what you're supposed to do in a disaster area. Apparently, if you do e-file, sometimes the IRS will still catch it. But I have never had a situation where the taxpayer was assessed late filing penalties if it was one of these situations where I was filing technically late, but they were allowed a disaster relief extension, and then I put the name of the FEMA disaster at the top in red ink, and then I mailed it in certified mail. Always ends up being no problem in that case. Now, if you do have a situation where you've decided to e-file and the person is in an affected county and it's a disaster and you know that they would qualify for relief, but the IRS assessed them penalties anyway, then there is a special number for you to call. All right, it's the IRS disaster hotline, and this is the number that you have to call to request the tax relief if the taxpayer is actually assessed penalties after the fact and you know they shouldn't have been. I still think that the best solution for this personally is if you're past the deadline, the IRS computers are just going to try to automatically assess penalties. That's what they do. It's a computer. It's not smart enough to know these things sometimes. But if you're to put the actual FEMA disaster at the top, North Carolina remnants of Tropical Storm Fred, in red ink, like it says down here to do, then I personally have seen this work every single time. It's been 100% success rate for me to do it that way. And then just mailing it in certified mail, as long as you do it before the extended deadline. And the IRS will always tell you what the extended deadline is for whatever disaster it is. It's going to vary. All right. So depending on the disaster, sometimes it'll be, 2 months, they'll give you an extra 2 months. Sometimes they'll give you an extra 6 months. When it was Katrina, when the Katrina disaster happened in New Orleans many years ago, the taxpayers were given many, many, many months additional in order to file. And there were taxpayers who were filing sometimes even years late and still obtaining refunds on a 5-year-old return because it was a Katrina disaster and it was so bad. So it depends on the IRS guidance. The IRS will always tell you the date. It's going to vary based on the disaster. It's going to be different every time. But in this case, for this particular disaster, it's December 15th. So I just want you to understand that sometimes you will have an entity that is in an affected disaster area where they've missed the extension deadline. So let's say you have an S Corp, but you happen to know that they're in a disaster area or they're in an affected county. That particular S Corp can potentially, you got to look it up on the IRS website. All right. You got to look it up, find out if the taxpayer is in an affected county or if their business is in an affected county. And if they are, then you can still file an extension on paper. All right. Your software probably isn't going to let you do it because it's past the normal filing deadline for extensions, right? So if you're at the end of March, the March 15th is the due date, the original due date for most S Corp returns, right? So you got to file an extension on or before March 15th. But if the taxpayer is in an affected county, in a disaster area, and they get one of those extended deadlines, then you could check the IRS website. And many times you are still able to file an extension, but you got to do it on paper and absolutely have to do it certified mail. And then you write on the top the name of the disaster. All right. You would write the name of the disaster on the top of the extension in red, and the IRS has to accept it. All right. So I just want you to understand that sometimes this is one of those areas where you kind of have to do like a little bit more deep dive. You got to have a little bit more knowledge in order to save your taxpayers, sometimes thousands upon thousands in potential penalties, because you could have a situation where the taxpayer just doesn't know. Most taxpayers don't know about these disaster relief extensions. I'll just tell you that right now. Most taxpayers don't know. So this is something that you have to be aware of. All right. But if you're in a disaster area, even if you aren't personally affected, you have to know that there are times where you might really be able to help somebody. If their business, if they themselves live in an affected county, or if their business is in an affected county, then they are considered affected taxpayers. And they would be considered affected taxpayers and eligible for tax relief for themselves as well as for their business, and vice versa. Okay, it's not just one of those things where, for example, let's say I live in an affected county, right? But my business is not in an affected county, but I live in an affected county. My business would be eligible for tax relief too, and vice versa, because I'm responsible for filing the return, right? So if I'm the owner of the S Corp, even if the S Corp itself, let's say I have like a dry cleaner store or a pet food store, and that store that I own is not in an affected county, but I live in an affected county, then I'm able to request tax relief. I'm eligible for tax relief, not just for myself, but also for my business, and vice versa. All right. If my business is in an affected county, but I'm not, then I would be considered an affected taxpayer if my business was an affected taxpayer. and I would have to wait on my business tax return in order to file my personal returns, which of course you have to, right? If it's a partnership or an S corp, you need the Schedule K1 in order to file your individual return. So the entity return has to be filed first. But if you have a situation where it's a partnership or an S corp and they're located in a disaster area like this, and they don't file until December 15th, 2021, because they have this extended deadline, then of course the individual taxpayers who are waiting on Schedule K1s from those entities would be affected taxpayers as well. That makes sense, right? Okay. But just so you know, if it's a situation where you get an e-file reject, or if it's past the normal filing deadline and your software won't let you file an extension, there's situations where you can file on paper past the filing deadline if it's a disaster relief extension. If for some reason the taxpayer still gets a penalty notice, they still get late filing penalties, and they're affected taxpayers, you have to call the IRS disaster hotline and request tax relief, which this is part of rep work. And you're going to have to be an enrolled agent usually in order to be able to do this, because you're advocating for the taxpayer. So of course the taxpayer themselves can request this kind of tax relief, but taxpayers don't want to call the IRS. They chicken out. They don't like it. They're scared. So this is one of those situations where you can get a 2848, a power of attorney, once you become an enrolled agent, and you can contact the IRS disaster relief hotline. And this isn't like an FTA. This isn't a first time abatement or anything else like this. Like you wouldn't have to do anything special to request this tax relief, because it's automatic. It's just that sometimes the IRS doesn't know, that the taxpayer isn't an affected county. So like sometimes you'll file a tax return with a PO box on it, right? The PO box might be in a different zip code than where the person actually lives. But if the person lives in an affected county, but they're using a PO box on their tax return, then sometimes the IRS computers they don't know. There's no way for the IRS computers to know that that person actually lives in an affected county. So sometimes you have to call to request the tax relief, because the IRS computers are just processing that return. So that's why I said, like, sometimes it's better to file that return on paper and put in bold red letters at the top the name of the disaster, right, in bold letters at the top of the form. And then the person who opens that envelope, the IRS employee, is like, oh, this person needs disaster relief. And then it goes in for special processing, which sometimes that's what you want. Sometimes you want a human to pick it up and go, oh, there's something going on here. Right? This is a disaster relief return. Okay? All right. Got it? Got it? Does all of that make sense? Okay. All right. So back to our slides. So the next couple of slides, which we're going to discuss, are going to be horror stories. Horror stories specifically about S corps that went to the tax court and had spectacular losses, so that you can understand what not to do. All right, these are things that you should not do, because if you do this and you end up in the tax court, you're going to lose. All right, so let's talk about the sample horror story number 1. And I'm going to mangle this name. I know it, because I don't know how to say this name, but it's a doctor, and it's Bebek Roshde. Bebek Roshide. Okay, I know that I mangled that name, but I tried. So this is Tax Court Summary Opinion 2014-113. These numbers, this means that this case was decided in 2014. And this is the 113th case decided in that year. And let me show you the link to an article about this case. So this is an article about the case. It's not the case itself, but of course you could look up the case if you wanted to. The case number is on the slide if you're curious. But this is an S corp failure to file penalty. Like I said, S corps generally don't pay income tax. 99.9% of the time they don't. The only time they pay income tax is if they were a C corp in the past and then converted, and they've got some income tax going on from when they were a C corp in the past. If the S corporation has always been an S corporation, then they don't pay income tax and it's a pass-through, right? But if the S corp files its return late, then the IRS is going to assess late filing penalties, and they are severe. They're severe. Now, when this article was written, the failure to file penalty was $195 per shareholder per month. And then there's an additional penalty for the Schedule K-1s that were not issued in time to the shareholders. So if you have a situation where it's an S Corp and they file their return late, and then on top of that, the Schedule K-1s are also issued late to the shareholders, there's a separate penalty for the late filing for the S Corp, and then there's also a separate penalty for issuing the Schedule K-1s late. So those are two separate penalties, and usually the IRS will assess both of them. Now, realize that this type of a penalty doesn't apply to individual taxpayers. And by individual taxpayers, I'm talking about natural persons, humans like us, right? So if you file your 1040 late, but you don't owe anything, and the IRS actually owes you money, right? So you're owed a refund, then you're not going to pay a penalty for failure to file or failure to pay, because the IRS owes you money, not the other way around. Does that make sense? So the late filing penalties that apply to individual taxpayers are based on the amount due. And if you don't owe anything to the IRS, or if the IRS owes you a refund, then you're not going to pay a failure to file penalty or a failure to pay penalty, because those are based on the amount due. Now, that also applies to C corporations too. I want you to understand that. A C corporation is not a pass-through. A C corporation doesn't issue Schedule K-1s. So if a C corporation, for example, C corporations always have to file. C corporations are like S corporations, where they have a filing requirement that begins upon existence. So as soon as the S corporation or the C corporation exists, then that filing requirement exists until the corporation itself is dissolved. But for example, if you have a C corporation that's just a shell corporation, or if you have a C corporation that has losses or zero activity, if the C corporation files a return and it's a loss, or it's just a zero return, because maybe the C corporation was formed, but it's just either a shelf corporation or it's a holding company, or sometimes C corporations will just be formed to hold an asset, but there's no actual business activity. So sometimes that will actually happen. C corporations can have that type of a legal purpose, where they're just holding assets, but they're not actually running a business. So some C corporations are just holding companies. If the C corporation files a return and it's just a zero return, or if the C corporation has a loss for the year, then there's no penalty for failure to file or failure to pay, because the penalties that apply to C corporations with failure to file and failure to pay apply to the amount due. If the C corporation doesn't have any amount due, or if the return is zero, then there's no penalties, because it's not a pass-through. Okay. But the penalties that apply to an S corporation or to a partnership are not based on the amount due, because S corporations and partnerships don't pay income tax. So in this respect, I want you to understand how different these entities are. S corps and partnerships will pay penalties based on how late the return is filed with the IRS. A corporation and an individual taxpayer, they can pay late filing penalties too, but those penalties are only going to apply if there's an amount due, because the IRS calculates the late filing penalties against corporations and individuals based on how much they owe the IRS. So if you don't owe anything to the IRS and it's a C Corp or an individual taxpayer, then there's not going to be any late filing penalties. But for S corporations and partnerships, they don't pay income tax. So when the IRS assesses penalties against an S corporation or a partnership, against the entities themselves, those penalties are based on late filing, how late the return is filed. Okay. Now, the facts in this case are that this doctor, okay, so I got to say the name again. I'm going to ruin it again, but it's Babek Roshide, was the sole shareholder in a California Medical Services S corporation. So this is a corporation that made an S election, which he's a medical doctor. So remember, I mentioned that if it's an LLC, an LLC can't practice medicine in California. So that option is not a legal option. But you can have a doctor medical doctor form an actual corporation, a C corporation at the state level, and then make a tax election with the federal government to be taxed as an S Corp. So this taxpayer is a sole shareholder of a California Medical Services S Corporation, which was the taxpayer in this case. So he's sole shareholder of his own S Corp. He's a doctor. Now, in this particular case, the taxpayer was known for having a history of filing federal income tax returns late. So the corporation had a history of filing its federal income tax returns late, and since it was a sole owner, it means that this guy basically was in charge of the whole shebang, and he's late multiple times in the past. But in this particular year, he was assessed like this whacking huge penalty, and he went to the tax court trying to argue that the penalty should have been much less because he filed an extension. Now, according to the corporate secretary, so this guy's secretary said that an extension was sent in to file a return by regular first-class mail. The IRS claimed that the extension request was never received. And of course, they just put a stamp on it and didn't pay for certified mail. I just don't get it. Like, there's so many cases in the tax court where the taxpayer claimed to have sent something first class mail and they didn't pay for proof of mailing, so they just didn't want to pay the $3, and then they end up spending thousands upon thousands of dollars in just trying to try their case at the tax court, because usually these people have to hire lawyers. Many times it's pro se, but I mean, you at least have to pay for the fees to file the tax court petition, and that's a lot more than $3 that you would have paid just to have proof that you mailed it on time. Why wouldn't you just pay the $3? But a lot of people don't do that, and this doctor guy didn't do that. So they just put the extension in the mail, regular first class mail. That's what he's claiming, or the secretary is claiming, but they don't have any proof that they actually did that. So they don't have any proof that they mailed it. Okay, this is like a tale as old as time. There's so many cases where this exact thing happened. And the extension was never received by the IRS. It's never received, lost in the mail, whatever. They don't have any proof that they ever sent it. Okay, so right there, that's like check mark number 1 against them. Okay. According to a certified transcript, the Form 1120S for 2010, so this was a 2010 return, and it actually took until 2014 for the tax court to decide this case. So it's a lengthy process if you decide to actually argue your case before the U.S. tax court. And in this case, it basically took several years for the case to go through this entire process. So according to the transcript, the Form 1120S for 2010 was received by the IRS via regular first class mail. Once again, they just mailed it without any proof of mailing. They sent it on January 31st, 2012. The IRS then assessed a $2,145 failure to file penalty based on the return being filed 11 months late. So this was 195 times 11, which equals 2,145. And this is what the owner of this S Corp was arguing against, because he's claiming that they filed the extension and then the return itself was only filed a month late. But they don't have any proof that they filed the extension because they didn't pay for certified mail, didn't want to spend the $3. And then on top of that, he doesn't have any proof that he mailed the return of when he actually mailed the return, and it was not received by the IRS until January 31st of 2012, which means to the IRS, the return was 11 months late, and the IRS was going to assess $195 per month for 11 months that it was actually late, which is a $2,145 penalty. Now, he's lucky that this was a single shareholder S Corp, because if it was multiple shareholders, then this penalty would have been doubled or tripled, because the penalty is based on the number of shareholders that the S Corp has and multiplied by the number of months that the return is actually late. Okay, so he tried to go through appeals, and appeals wasn't buying his argument because he had no proof that any of this was mailed on time. He had no proof. So at trial, the taxpayer claimed that a timely request for a 6-month filing extension to September 15th, 2011 had been filed for the 2010 federal tax return, and that the return had actually been filed on October 15th, 2011, which is 1 month late. A lot of people kind of get confused, especially if they're not tax professionals. They get confused by the due dates, and even some tax professionals get confused by the extended due dates, to be honest. They don't realize that October 15th is the extended due date for C Corps and individual taxpayers. But the extended due date for partnerships and S Corps is September 15th, which is a month earlier. And he claimed that he filed his S Corp return October 15th, which he probably thought was the actual deadline, but his Corp return was due on September 15th, assuming that his extension had been filed on time, but the IRS had no proof of the extension going in either, and he didn't have any proof that he mailed it. It was just his word against the IRS's. And since he had no proof, he lost on that point too. Maybe the IRS would have caved if this person had a history of filing timely, but he had a history of filing his returns late. So the IRS had no reason to believe him, and either did the U.S. Tax Court. All right, he had no proof, and then he also had a history of doing this in the past. So he couldn't fall back on his good behavior. The taxpayer's corporate secretary also claimed that he had filed extension requests for every corporate tax year from 2002 through 2013. But once again, the secretary offered no evidence to support his claim. The IRS provided certified transcripts showing that it had received extension requests for only 6 out of the 12 years. Finally, the taxpayer was unable to offer proof that the 2010 return was filed on October 15th, 2011, as he claimed. Because once again, he didn't want to spring for the certified mail because it cost $3. Which it just kills me. He's a doctor, right? So because he didn't want to pay the $3 for the extension to go in certified mail, and he didn't want to pay the $3 to send in the return certified mail, he didn't want to pay the $6, then he lost $2,145. That's a very expensive lesson, right? It's a very expensive lesson right there. Because he could have prevented all of this by just going onto the USPS website. I mean, even back then, in 2011, you could print postage online. It was not, that sort of technology existed 10 years ago or 11 years ago. He could have done it. He could have just printed a label and then had one of his employees go down to the post office and scan it, and he would have been golden. It would have been fine. But he didn't want to do that. He didn't do it. He just put a stamp on the letter. The IRS never received the extension, and he had no proof that he mailed it. And then when the return went in, he had no proof of mailing the return on time either. So he lost. He lost big time. He lost $2,145. And then on top of that, any other penalties that the IRS assessed, because he was still fighting this in the U.S. tax court without paying this amount due. And then he lost the case. So he would have owed at least interest on top of this when this case was decided. But he lost. That is horror story number 1, or cautionary tale number 1. All right, let's talk about Flesher versus Commissioner. You've got to know about this case. I don't think that there's any other S Corp tax court case that has gotten more press than Flesher versus Commissioner. This case has been written about. It's been argued about. There's a million articles out there about it. But surprisingly, there are still a lot of tax practitioners that don't know about this case, because questions similar to this scenario pop up on the tax groups all the time. And there's always like one of the more experienced tax professionals, or one of the educators at least, who will pop out and say, do not do this. Do not do this. So Flesher was a certified financial planner. He was a CFP, a licensed certified financial planner. He tried to use an S corporation to limit the SE tax on his investment commissions. So a lot of taxpayers who have a business and they're self-employed, they get recommended S corps in order to kind of mitigate self-employment tax. It's good for people. Let's just put it this way. It's good for businesses who are making like maybe mid six figures. It's a tax planning device, right? And it depends on the taxpayer, what their business purpose is and what they really want to do with the business. A lot of tax professionals will recommend S corporations in order to kind of mitigate self-employment tax. So this person was a certified financial planner. He was recommended to S corporation to limit self-employment tax on his investment commissions. So he was earning investment commissions, presumably as a self-employed person. He was selling insurance products, like as an insurance agent, as well as a investment advisor. So he was making money as an investment advisor as well as an insurance, selling insurance. And if you're self-employed, then all of his insurance commissions would have been subject to self-employment tax on Schedule C, right? So you can kind of understand the scenario that was occurring here. And then he went to a CPA, and the CPA was like, hey, why don't you try an S Corp? But here's the problem. The problem was that this particular person, Flesher, was licensed as a certified financial planner in a state where it was legally impossible for his corporation to contract directly with insurance companies. Because in that taxpayer state, only an individual or a natural person and not a corporation could be personally licensed as a registered representative or agent. Now, laws are going to vary from state to state, but there are many states where it's a situation like this, and it's a particular licensing where that licensing can only be held by an individual person, a natural person. And the commissions from that licensing for an insurance agent or a certified financial planner or a registered representative, usually like selling securities like stocks and bonds, many times due to state law, the commissions cannot be paid to a corporation. They can only be paid to a human being. The insurance commissions were technically paid to Flesher, the certified financial planner, the guy. And then the CPA put them on Schedule C and then backed them all out, like backed them out as an expense and put all of the amounts as if the S Corp had earned them on the S Corp return. And you're not allowed to do that. What ended up happening in this case is that, okay, and I know that many of you listening to this, your little butts are puckering up because maybe you have one of these people in your client base and you're thinking, ooh, this might end up being a problem. And yes, it's true. It is a problem. And it's one of those things where the IRS just hasn't caught up with you yet. If it's a situation where state law prohibits the taxpayer, because of the nature of their license, from having those payments paid to an S corporation, you cannot put those amounts on a Schedule C and then back them out and then put them on an S Corp, because the S Corp can't earn that money legally. In this case, the S Corp could not earn that money. Now, I've read several articles about this case, and I'm going to show you one of the articles about this case. It's fairly recent. Accountants talk about this case all the time. So one of the quotes that I've read on multiple articles regarding this case is that pigs get fed and hogs get slaughtered. So pigs get fed and hogs get slaughtered. I've seen that particular phrase on multiple articles about this case. And there's a strong belief in the accounting community that this guy, this certified financial planner, Flesher, got flagged and got audited by the IRS because he was greedy. He was making huge amounts of money, but his salary was really low compared to the amount of net income that his corporation was earning. Now, the linchpin of the IRS's argument was that the corporation was never earning any of this revenue to begin with, which is true. Ryan Flesher was a financial advisor for LPL and Mass Mutual. He's like an insurance agent. And he was receiving payments like commissions and ultimately a 1099 miscellaneous, right, for non-employee compensation, which is how non-employee compensation was reported to taxpayers in the past. Now it's the 1099 NEC, but in the past it was the 1099 miscellaneous. You guys know that, right? So because of the licensing laws that existed, he couldn't received that money via his corporation because the compensation payments could not be made to an entity unless the entity itself is a registered broker dealer, and in some cases a registered investment advisor or an RIA, which he was not. So he would report the income. He had a CPA advising him. So what he did was the CPA reported the income on the Schedule C and then had a singular line item for other expenses resulting in a zero profit. So they would expense out all of the income that he made. Too convenient, right? So through a random audit, this is why he was flagged probably, the IRS issued a tax deficiency for all the years in question amounting to over $41,000 in tax. And here's a summary of his business income and salaries. This is all in the case docs, right? So you can look up the actual tax court case and it's all in there. 2009, the net income from his investment business was $46,000 and he received salary or wages through his S Corp of $34,000. His distributions were $11,924. So the wages, the salary, of course, was subject to Social Security and Medicare tax because it's payroll, right? But then the distributions were not subject to payroll tax or SE tax, which is the big benefit of S corporations, right? Right. Okay. So he was all happy about that, right? In 2009. Okay, so here's the problem. 2010, he made $182,498, but his salary stayed $34,000. The distributions were $147,000, and his salary stayed at $34,000, which is, let's be real, that's really low. And it's probably the reason why he got flagged. He did the same thing in 2011, where he made $150,000, and then his salary stayed at $34,000. And his distributions were $115,327. So he presumably took distributions for the S Corp, which means he took the cash out. And then on top of that, the IRS also had the argument that the S Corp couldn't earn this money legally because of state law. So he was receiving the money on a 1099. He was receiving the revenues, the income on a 1099, because the money couldn't be paid to the S corporation because the law wouldn't allow it. This was like this backdoor chicanery that the CPA was doing, and it wasn't legally allowed because of the type of licensing that he had. So the IRS basically treated the S corp as not existing, like as the S corp couldn't earn this money. So it was the IRS assessed all of this tax, income tax and self-employment tax on this taxpayer because this is what he would have paid if it had been reported properly on the Schedule C, because legally the S Corp couldn't earn this money. Do you understand the crux of the case? All right. So if you have a taxpayer that's doing this, they need to stop. My advice is that you need to tell them to stop. They need to stop doing this. If it's a situation where because of state licensing requirements, they're being issued a 1099 personally, and then they're trying to allocate that income to the corporation. You can't allocate income to a corporation if the corporation can't legally earn that income in the first place. Okay. Now, I'm not talking about a situation where maybe you have a taxpayer who just formed an S Corp and this is their first year there, and it's a situation where the company can legally earn the income, but maybe they didn't issue a form W-9. This is a request for taxpayer identification number. And they have a vendor that gives them a 1099 to them personally at the end of the year, and then they don't want to fix it, but it's just a one-time deal. It's the first year that they've become an S Corp, and then the vendor won't fix the 1099. Then that personally for me, that's okay. I'll do it once where, I'll put it on the Schedule C and back it out with a statement. And I'll say what I'm doing, and I'll say, the vendor or the payor refused to correct this statement. But I'm talking about a situation where that's a one-time deal and the vendor just won't correct the 1099, but it's not a situation where the corporation can't legally be earning the income like in the Flesher case. In the Flesher case, the CPA was allocating the income to the corporation, but the corporation couldn't legally earn the income in the first place because of state law. And if you have a taxpayer like this, they need to stop doing this. Income to an S corporation can't be allocated, like magically allocated from a 1099 that a taxpayer earns. All right. It can't You can't do it. And if you have a situation where a taxpayer forms a new S corporation, then what they need to do is immediately they need to issue the W-9 to their vendors, so the vendors know that the 1099s, if they do have 1099s coming, should be issued to the S corporation. Now, 1099s don't have to be issued to S corporations, but some vendors will do it anyway. It's not required if you have an S corp or a C corp, unless it's a lawyer. There's an exception for attorneys in the law. It's all in the 1099 instructions. I'm not going to go over that right now because we're talking about S corps. But if you have an S corporation where it was previously a partnership or an individual, like a sole proprietor, and they formed an S corporation, like for example, in the middle of the year, this is their first year, you got to make sure that the vendors know either that they don't have to issue the 1099s anymore, or if they are going to issue a 1099, that the 1099 has to be issued to the corporation and not to the individual taxpayer or to the partnership if it is a partnership. Got to stay on top of that. Let's talk about Deckard versus Commissioner. This is the third cautionary tale that I'm going to talk about. So this is a taxpayer who formed a non-stock, not-for-profit corporation, but he never applied for federal tax exempt status. So his intent originally was to raise money for the conservation and maintenance of the waterfront park in Louisville, Kentucky. All right, so this was in Kentucky. And his intent was to form this nonprofit in order to conserve a waterfront park. That's an exempt purpose. It would have been fine. He could have been a 501c3. Conservation purposes, that's a charitable purpose. But he never applied for federal tax exempt status. But he formed a non-for-profit corporation. Now, many of you might not know this. In most states, there's many different types of corporations, and this is why I always refer these types of questions out to lawyers. I don't file articles of incorporation or articles of organization if it's an LLC or an LLP. I don't do that for clients because I don't want to make a mistake where there's a problem between the licensing restrictions of the state or something like this, where this guy formed a not-for-profit corporation and then he ended up using it as for-profit purposes. Now, let me show you on the Nevada website. That's the only state that I have experience with when it comes to this sort of thing. So I'm going to show it to you on the Nevada website. So this is the Nevada Secretary of State, all right? And I'm in Nevada, so this is what I'm showing you because this is what I have experience with. I've formed corporations for my own businesses, so I've done the formation myself. And I've also done formation for LLCs for my own businesses and for my husband's businesses, but I've never formed them for clients. And if somebody asks me, do I need to file a Nevada corporation or a Nevada close corporation or a Nevada professional corporation, I don't know the answer to give them in that case. So they have to go to a lawyer to do this if they want to do this, or, presumably they could do it themselves if they feel confident in their own abilities. There's a lot of services that will do the formation for you online, but I don't do these types of formations for clients. I know that there are CPAs and EAs that do that. I don't do that personally. All right. But here's the example that I wanted to show you. In Nevada, there's multiple types of corporations. 1, 2, 3, 4, 5 different types of corporations. And we're not even talking about LLCs, LLPs, or LPs. Those are different entity types altogether. These are just corporations. These are all different types of corporations that can be formed in Nevada. And all of the articles of incorporation are different. If you want to form a nonprofit, the nonprofit corporation articles of incorporation are different and the laws are different. There's certain things you can't do if you're a nonprofit corporation. Now that you know this, let's go talk about the case. So this case was actually decided in 2020, so it's recent, but the actual entity was organized in 2012, and it was organized as a non-for-profit corporation at the state level, but he abandoned his plans to run it as a nonprofit in August of 2012. So like a few months later, he was like, I don't think I want to be a nonprofit. I think I want to do this as a business instead. But he didn't bother to form a for-profit corporation. He just kept the nonprofit because I guess he paid the money to form it, and he didn't want to waste that money. So he just decided to use the same corporate charter corporation, but the problem is that it was a non-for-profit corporation. So a non-for-profit corporation can't be run for profit. And exempt organizations cannot distribute any part of their earnings to their directors, officers, or other private individuals. They're not allowed to do that. So exempt organizations can have employees, and most of them do, right? So you have a big exempt organization like, the Red Cross or something like that. They have employees, but the money, and they can pay those employees wages, right? But an S corporation pays wages, but it also makes distributions to the shareholders. Exempt organizations can't distribute their earnings to directors, officers, or private individuals. It's a charitable organization. They're not allowed to do that. For-profit companies can do that, but exempt organizations can't. Deckard, the taxpayer, abandoned his plans to run Waterfront as a nonprofit, and then he filed S Corp returns for 2012 and 2013. He filed Form 1120S, reporting losses of $277,967 and $3,239 respectively. I read the whole case. All right. He put on some kind of fashion shows or something, and the fashion shows lost money. So I guess he thought it was going to be like some big fundraiser, and it ended up not being profitable or not raising money like he thought it would, I guess. And instead of treating it as an exempt organization, I don't know if he got some kind of cockamamie tax advice from some tax advisor where, they said, hey, you lost all this money, put all this money in, just like run it as an S Corp. What could go wrong? The returns were chosen for audit, probably because they had these huge losses. He passed the losses through to himself, listed as Waterfront's sole owner. And he reported these losses and took huge tax deductions on his 2012 and 2013 individual tax returns. The returns were selected for audit. All the losses were disallowed by the tax court. And like I said, this was just decided in 2020, so it's a recent decision. According to the court, under Kentucky Nonprofit Corporation Acts, Waterfront could not issue stock because, remember, it was a non-for-profit corporation. This is what he formed in the first place. And I've read several articles on this. Apparently, he could have gone to a lawyer at some point and converted the not-for-profit corporation to a for-profit corporation at the state level, but he never bothered to do that. So he never got competent legal advice or competent tax advice anywhere in this scenario, but he could have converted the corporation legally to a for-profit corporation, but he would have had to go to a lawyer to do that, and he didn't do that. So when he filed his returns, the underlying legal entity was a not-for-profit corporation, and the IRS attorneys sniffed this out. Right? They looked at the articles of incorporation and they were like, hey, this is a not-for-profit corporation. What are you doing? And the Kentucky law, the Nonprofit Corporation Acts, so the law of the state of Kentucky, prohibits the distribution of any of Waterfront's assets to Deckard in the event it is dissolved. This is a right that's typical of a shareholder. So if a corporation that's a for-profit corporation, right? So if it's a C Corp or an S Corp and the corp dissolves, then the assets of that corporation, whatever money is in the bank or the corporate assets like machinery and equipment, typically in a dissolution, those assets, if there are any, they get distributed to the shareholders. That's a right that the shareholders have. It's to receive the assets of the corporation when the corporation shuts down. But with an exempt entity, that's not allowed. You're not allowed to distribute assets to directors, officers, or private individuals. Generally, when you have an exempt entity and the entity dissolves, exempt entities dissolve too. Sometimes exempt entities shut down. What ends up happening is most of the time, if you have an exempt entity that shuts down, they're usually insolvent. Or if they do have assets, those assets will be distributed to another charity. That's typically what happens, all right, in the real world. But the problem with this guy, Deckard, is that he tried to distribute losses to himself, but his corporation couldn't legally do that because it was a non-for-profit corporation. And the tax court held that a director and officer of a Kentucky nonprofit corporation was not a shareholder of the corporation for the purposes of making an S corporation election or claiming pass-through losses of the nonprofit corporation. And I have a link to a good article on the case. This is actually a legal blog, which I follow, where they talk about it. So I know that most of you are not lawyers. We do have lawyers that sign up for the Passkey course. But I know that most of you are not lawyers. If you have a taxpayer who does this sort of thing, where they go out and they form their own entity, and it is a not-for-profit corporation, then they can't operate as an S Corp. It's not legally possible. What I want you to take from this is that the underlying legal entity matters. And this guy could have fixed this if he had seen a lawyer early on and converted the corporation early to a for-profit corporation. He could have done it. That's possible. You can convert a nonprofit to a for-profit corporation and vice versa. That's legally possible. Lawyers can do that. But he didn't do that. And when he filed these returns, they went in late, by the way, but when he filed these returns, the underlying entity was still a not-for-profit corporation, and the IRS basically put the kibosh on the whole thing. All of the losses were disallowed. So presumably he was hit with huge penalties because this was like a scheme that failed. All right? Okay. So cautionary tale number 3. All right, let's talk about the Form 2553. This is the S election form. This is the form you have to file if you have a corporation or, for example, an LLC, and one of those entities, the corporation or the LLC, wants to elect S status to be treated as an S corporation at the federal level. So you don't file the Form 8832. In the past, 10 years ago or so, it used to be that if you had an LLC, for example, or an LLP, like that private letter ruling that I discussed several slides ago, you would have to file the 8832 to have that LLC or that LLP or that LP to be treated as a corporation first, and then you would file the Form 2553 to have that corporation treated as an S Corp. So there was 2 steps. Now you don't have to do that anymore. So whether it's a corporation or an LLC or any other entity type that's a qualifying entity, you just file the Form 2553. That's it. That's the only form you have to file. So the law changed about 10 years ago where you don't have to jump through these extra hoops anymore if it's an LLC. Now, this form is due within 75 days of forming your business entity or by March 15th of the following year if it's an entity that's converting. So if you form your entity this year and you want it to be treated as an S Corp from the beginning, from the very beginning, from the get-go, you have to file the Form 2553 within 75 days if you want it to be on time. There is a late election procedure, which is really common, but I'm just telling you right now, the IRS is a dumpster fire. They are screwing these up like left and right. So if you have a situation where it's a taxpayer that's formed a new entity and you want it to be treated as an S Corp from the very beginning, like let's say they formed an LLC, you need to get this in on time. All right, because the IRS has been screwing up these late elections. So try to get this election in on time if possible. And if you have a situation where the taxpayer has formed a brand new entity, like they form it in the middle of the year, you're going to want to make sure that you fill out the Form 2553 within 75 days of formation. If it's a business entity, let's say it's an LLC and it's a sole proprietor, and that sole proprietor has been filing a Schedule C for several years. All right, this is a common scenario. They're an LLC, they've been filing just Schedule Cs for years, or maybe it's a husband and wife partnership, it's an MMLLC, multi-member LLC. And they've been filing the Form 1065 for several years, and now they want to convert. and they want to convert to an S corporation, but they want to do it on the first of the year. So they're still going to continue to file the Schedule C and the 1065 for this tax year. But for the following tax year, right, they want to be treated as an S Corp. Then you can file the Form 2553 by March 15th of the following year for the year that you want to be treated as an S Corp. And that's for an entity that's converting. They were something else, and now they want to be treated as an S Corp starting with the following year. Now, late elections are possible using IRS Revenue Procedure 2013-30. Late elections for a C Corp are possible too. It's a different revenue procedure, just so you know. But if it's an S Corp that's filing the 2553 late, then it's IRS Revenue Procedure 2013-30. This is what you write on the top of the form. And if you are sending it in at the same time you're sending in the first tax return, that's actually possible. You can do that. You would write this on top of the form as well. So, on top of the form, as well as on top of the S Corp return. And the reason why I'm saying you have to write it on top of the S Corp return is because most of the time these have to be filed on paper, because you can't e-file if the election is going in late, because you'll get an e-file reject for entity type. So the only way to file the return is to mail it in with the late election, with the 2553, as well as the tax return by March 15th. I really recommend that you do it by March 15th, okay? If you're going to do it that way and you're going to be sending in the late election with the first tax return. And to be honest, if it's late, I think that that's the best way to do it. Personally, this is my personal opinion. If it's a situation where the 2553 is going in late, it's going in late anyway. You missed the deadline. You didn't get it in within 75 days. I usually recommend that rather than faxing it, because you can fax this form, but I only fax the form if I know it's going in on time. If the form is going in late and I'm asking for late election relief, then I think the best way to do that is to send in the Form 2553 along with the first tax return, and it has to go in on paper because you're going to get an entity selection mismatch if you try to e-file, because the IRS hasn't approved it yet, obviously, because the late election is going in with the tax return. So that has to be processed first. So the only way to file it is to file on paper. And if you do file the 2553 late along with the tax return, then everything has to have a wet signature. Now, taxpayers as well as tax professionals get confused on what a wet signature is. Lawyers know because they know the difference between a wet signature and a handwritten signature and an e-signature. A wet signature is ink on the paper that is wet, which means you write it with a pen, and if you go to a lawyer's office, they always use blue ink. And I know this because this is what they did with my will, my last will and testament, and as well as the trust that I have set up. So it's always blue ink. And if you write your signature with ink on the paper and it's not reproduced, like it's not a photocopy, it's original ink on the paper, that is a wet signature. That's the only thing that's a wet signature. And sometimes tax professionals will throw the word wet signature out there. If you have something that was faxed to you, that was signed by the taxpayer, it might be a handwritten signature, but it's not a wet signature if it's not an original signature made with a pen. All right, that's a wet signature, which means the taxpayer is going to have to come in and sign that paperwork themselves. It's not, you can't use a digital signature if you're sending this in on paper. You can't do that. If you're sending it on paper with the tax return has to have an original wet signature, and the 2553 has to have an original wet signature on the jurat. So the jurat is the statement at the bottom of the tax return, as well as on the 2553 that the taxpayer signs under penalty of perjury. All right? And the revenue procedure for late elections is 2013-30. It's kind of long. It's like 30 pages, but if you read through it, it tells you exactly what you have to do. There's also several courses out there that you can watch that go through the late election procedure, and will even give you like sample forms. I'm going to show you a sample form, but I'm going to show you a sample form of a 2553 that is for an entity where it's being sent in on time. The late election potentially can allow an entity to get relief and elect S Corp status within 3 years and 75 days from the date the election was originally intended to be effective. They are extremely common. Late elections are extremely common, but acceptance is not guaranteed. So I've personally never had one denied, a late election, but I've never tried to go back more than 1 year to obtain a late election. And I have heard from other tax practitioners where they've tried to go back 3 years and the IRS wasn't having it. It was denied. So remember, the late election is a request. And I know that they're extremely common, but the IRS, I'm just being real, the IRS screws these up all the time. And many times you'll request, maybe going back to 2019, and the IRS will say no. And they'll say, okay, well, we'll request your late election, but we're not going to allow it to 2019. We'll only allow it to 2020. We'll only allow you to go back 1 year. So I've heard of all kinds of stories like that. And if that happens, if the IRS does not accept your late election, or they give you the incorrect date, or they give you a date that's not as far back as you want to go, then the only other option the taxpayer has is to request a private letter ruling, which costs $10,000. So really try to get these in on time if you can. So the acceptance is not guaranteed. If you do send it in and you send it in as a late election and the IRS doesn't accept it, then the only other option is a PLR, and that costs $10K minimum. All right. So yeah, try to get these in on time if you can. As I stated, there's a handful of states that require a state level election. And then the election sits on top of your legal entity, and it only applies to your tax filings. The legal entity does not change. So if you have an LLC and you make an S election for it to be treated as an S Corp, it's treated as an S Corp only for tax purposes, for IRS purposes. The underlying legal entity is still an LLC, okay? That the legal entity doesn't change. So let's look at a sample Form 2553 and a sample notice of acceptance. I found a sample online that's pretty good of a Form 2553 that's filled out. And then the sample notice of acceptance is a notice of acceptance that I have where I've redacted the client's information because I couldn't find a sample of this online. But let's go over the sample Form 2553 first. So this is an election by a small business corporation. I have this link in your slides so you can download this. It's just a sample from a website where you can form business entities yourself. And what you do is you put the name of the company here, the employer identification number, which you would have to request from the IRS. All right, you'd have to request the EIN. You put the address and the city, the state, the zip code. That's all easy. And you put the date that the company is incorporated. That's what goes here. So a lot of people get confused by what date goes here, which is the election to be effective date, and the date of incorporated here. The earliest that you can go back and elect S status is the date of formation. All right, the date of formation. That's the date that the entity is actually formed. And it's going to be on your articles of organization. So that's what this looks like. I found a sample on the SEC website. This SEC website is the Securities and Exchange Commission. So this is all public information. This is for a company that is like publicly traded or something. And I thought it was hilarious because the name of the company is called Lovin' Oven. Lovin' without a G. Like Lovin' Oven LLC. So Lovin' Oven is an LLC formed in the state of California. And these are limited liability company articles of organization. Now, if it's a corporation, it says articles of incorporation. But if it's an LLC, it says articles of organization rather than articles of incorporation. All right, so corporation is articles of incorporation. If it's an LLC, it's articles of organization. So you're going to get a paper like this. Looks like this, depending on whatever state you practice in. And it has a state seal on it. And the date is right here. So I think this is August 30th. It's a little bit blurry. But the date that this was accepted by the Secretary of State, it was August 30th, 2002. So in this case, if this LLC wanted to be treated as an S corporation, this would be the earliest that they could go back. The date that's stamped on their articles of organization. And if it's a corporation, it's the same deal. If it's a corporation, the earliest that the corporation can go back and elect S status is the date that the corporation is actually formed, which is right on the articles of incorporation. All right, you got to get a copy of this if you're helping a taxpayer do this, because there's no way, you got to get a copy of this. You got to see it. So the taxpayer should have this. They should have the articles of organization for their LLC, if it's an LLC, or if it's a corporation, they've got to have the articles of incorporation, and it'll have the date right there. All right? Okay. The date that the entity was formed at the state level. So that would be the date that you would put there. Now, the date that you want the election to be effective, the earliest you can put is the date that it was actually incorporated. You can only go back as far as the date that the entity has existence. And a lot of tax professionals get confused by this. So this is a question that comes up constantly in the groups. If this company wanted to be treated as an S Corp in 2017, for example, when it was formed, then they would put 11/1/2017 here. That's the earliest that they would be able to go back, which in this case, in this sample, it's 11/1/2017. And you would put 11/1/2017 here, and that would be a short tax year. So the majority of the 2553s that I've filed have been like that, where the company was formed somewhere in the middle of the year. Usually companies are not formed right on January 1st, right? So if you form an LLC, it's going to be sometime in the middle of the year, because you're not going to get up after partying all night on New Year's Eve and get up right on New Year's, right on January 1st, and form that LLC. And so most of the time it's a short tax year, right? Because a full tax year is from January 1st, which is New Year's, all the way to December 31st. So the first year is always going to be a short tax year, because you're going to form it, after January 1st, because January 1st is a holiday, right? All of the secretaries of state are closed. They're not going to be approving your corporate paperwork right on January 1st. So the earliest that you can elect S status is the date of formation of your entity. And the place where you find that date is right up here, or, wherever your particular state is stamping these things. But usually it's at the top of the actual articles. Okay, that's where you would look for it. And that's the date you would put there. Now, most of the time it's going to be a calendar year. There are some times where S Corps file on a fiscal year, but that's unusual. Most of the time, S corporations are on a calendar year unless they have a legitimate business purpose for being on a fiscal year. Most of the time, they're calendar year. Now, if you have a large S corporation, the S corporation has 100 shareholders, but they have shareholders who are treated as a single shareholder because it's multiple members of a single family and they're near that 100 shareholder limit, then you have to check this box. Okay? Most of the time, you're not going to be dealing with these extremely large S corporations. You're going to be dealing with small S corporations where it's just one or two shareholders, maybe a husband and wife, two spouses. That's what you're going to see. So you're probably not going to be checking this box. Okay, most of the time you're going to be leaving this box unchecked. Now the next line, line H, is for the name and the title of the officer or legal representative who the IRS may call for more information. So what I put here is, the company president, John Doe, John Smith, whoever it is, and then you put their title after their name and then the telephone number. If the S corporation is being filed late, you would put the reasonable cause statement here. If this 2553 is being sent in on time, you just leave this blank. The signature of the officer, the title of the officer, if it's like company president, company officer, and then the date that it's actually being signed. And this is a jurat, which means this is signed under penalty of perjury. If you're faxing this in and it's being faxed in on time, you can fax in the form 2553. If you're faxing it in, obviously it doesn't have to be an original signature because it's being sent in by fax. But if you're mailing this in, Then it has to be a wet signature, which means it has to be an original signature signed with a pen. Now, you put the name and the address of each owner down here. Every single owner has to be listed. If it's only one guy, then you're only going to have one name on here, right? But if it's multiple owners, let's say 4 shareholders, they all have to be listed here, and each one has to sign. Each one has to give consent. There's a shareholder consent statement, and once again, it's under penalties of perjury. This is another jurat. And each shareholder has to consent to the S election. So 100% of the shareholders have to consent to this. And I've talked about this in the webinars for part 2. If it's a C Corp, for example, if it's an S Corp that wants to be taxed as a C Corp, so an S Corp converting to a C Corp, you only need majority consent, which means more than 50%. If there's a couple of shareholders that don't want to do it, but the majority of the shareholders do want to convert to a C Corp, then the majority of the shareholders can do the conversion without the consent of all of the shareholders. They only need the consent of the majority, so more than 50% of the shareholders have to agree. That's not the case in reverse. So if you have a C corporation and it wants to convert to an S Corp or make an S election, an initial S election, all of the shareholders have to consent. And all of them have to be qualifying shareholders. That goes without saying, right? So if you have a corporation, let's say it's 10 shareholders, and one of those shareholders is a non-resident alien, then you're not going to be able to make the S election in the first place, because all of the shareholders have to be permitted shareholders, and they all have to consent to the S election in order for the S election to be valid. So if it's just one guy, which is, most commonly what you're going to be doing here, if it's just one guy, you put his name or her name here. The shareholder signs here. You put the date of the signature. Pro tip, I think the dates should match. All the dates should match. Just make them all match. That's what I think you should do. But that's just my professional advice, to make all of these dates match. And then if it's just one owner, then the number of shares or percentage of ownership, you just put 100% right here. All right, 100% owner, because it's just one guy. The date acquired would be the date of formation. You put the date of formation, the date that the company was actually formed. That's the date that you put here. And then you put the social security number of the individual, if it's an individual taxpayer that owns the shares. Now, we've talked about the other types of entities that can own shares in an S corporation, which you're probably not going to see very often, if at all. Like a 501c3 that owns shares in an S corporation, then you would list the charity's name here. An officer of that entity would have to sign. Okay, you would put the date of the signature and then the percentage of ownership that entity actually owned of the S corp. The date that they acquired those shares. And then if it's an entity, you put the EIN. And then potentially you might have, if you have an entity that owns shares in an S corp, which like I said is unusual, then you might actually have a situation where that entity actually has a tax year that's different than a calendar year. That entity might have a fiscal tax year. So you would put that fiscal tax year end here, whatever it might be. But if they're just natural persons, if the shareholders are just humans, natural humans, which is 99.9% of what you're going to see, then individual humans report their income and loss on a calendar year, and you're going to put the tax year end of 12/31, because that's your tax year end. That's my tax year end, because we're humans. Okay, so that's what the date that you would put there, 12/31. All right. Now, this page 3, you're probably not going to be using, because this is when the S corporation wants to select a fiscal tax year and you put in your reasoning. So if there's a business purpose, or if it's an ownership tax year, or it's a natural business year, like for example, for a seasonal business, and the S corporation wants to request a fiscal tax year. But I honestly have never used this page 3. All right, I've only filled them out for S corporations where it's natural persons, and the S corporation files on a calendar tax year, which is 99% of what you're going to see. Okay, so probably you're only going to be doing a Form 2553 where you have to fill out page 1 and page 2. Okay, so that's how you fill this out. So let me show you a notice of acceptance. So this is a notice of acceptance from the IRS. This is really important. You have to make sure that the 2553 is processed correctly by the IRS and that you get this notice of acceptance. This notice basically says, yes, the IRS has accepted your 2553 and your company is now recognized as an S corporation. This notice of acceptance is really important. It should go into the taxpayer's permanent record, just like the EIN letter and the articles of incorporation or the articles of organization. It has to be all like scanned or kept in that permanent file. And if you are the one that's dealing with the client, the S corporation itself, then you need to get a copy of this. Absolutely. And I'll show you some examples. We're going to talk about some horror stories from other tax practitioners of what happens when the tax practitioner doesn't keep up on this and the notice of acceptance is not received or processed or whatever you want to call it, where the tax practitioner doesn't have proof that the 2553 was processed correctly, but the tax practitioner went on filing S corp returns and the IRS wasn't recognizing the company as an S corp. There's several horror stories out there that I've heard recently just like that. So this is a notice of acceptance, and I want you to understand the scenario in this case. This was a situation where I had filed a 2553 for an LLC that was making an S election, and I filed it on time. The LLC was actually formed on March 27th of 2019, and I sent in the 2553 in April. So it was definitely on time, but I sent it in as a fax. Back in 2019 and early 2019, the IRS wasn't as much as it is right now, a dumpster fire where the 2553s were getting lost in the shuffle and everything else. In 2019, I sent this in, I think it was at the end of April. So the 2553 was sent in on time, but it was faxed. I waited 7 months before calling the IRS about this issue. I got a Form 2848, which is a power of attorney, and I contacted the practitioner priority line. I got a power of attorney from the entity itself. Okay, you have to do that if you're going to be calling about this sort of thing. So in this case, I got the Form 2848 power of attorney for the entity itself. And I contacted practitioner priority line and I asked about this. So I waited 7 months. It was sent in sometime in April, and then I didn't contact the IRS until November. But I did contact them before the end of the year because I didn't want to be like in January or February not knowing what was going on. The operator for the practitioner priority line, Mrs. Bishop was her name, right? So the customer service representative. She was very nice. She said, we received the 2553, but the notice of acceptance didn't go out. All right. She admitted that. And I said, well, can you send me a copy? And she said, I can fax it to you, which she did. So that another reason, where I've already mentioned this, another reason, great reason to have a fax line is because the IRS sometimes will fax you these things. They will fax you things that you need, like this notice of acceptance, for example, while you're on the phone with them. So she faxed this to me and I received the fax and voila, I've got my notice of acceptance. Taxpayer's fine. And it says, we accept your election to be treated as an S corporation with an accounting period of December 31st, beginning on March 27th, 2019. So that was the date of formation. The LLC was actually formed right on March 27th, 2019. So that was the date that I put in on the 2553 that I wanted the S Corp election backdated to. That's the earliest you can go back is the date of formation, which is what I did. So the first tax year, obviously, is going to be a short tax year, which it is most of the time when you have a brand new corp. All right, brand new corporation. So please keep this letter in your permanent records as proof of acceptance of your election. Note, if we examine your return, we will verify that this election is appropriate for your situation. And then it says, if you have any questions regarding this letter. So this is what a notice of acceptance looks like. It's going to be something like this. It's going to have the taxpayer ID number here, which I've blacked out. And then the taxpayer's name and address, the name of the company and the company address up here. And you have to keep this in your permanent record, and the taxpayer has to keep it too. If you don't get a notice of acceptance and you don't verify that the company is an S corporation, do not assume that just because your e-file, like you send in an e-file for that S corp and it's accepted by the IRS, that those returns are being processed correctly and accepted. And there's tons of horror stories out there, and I'm going to go over some in just a minute, of situations where the notice of acceptance was never received or the 2553 was never processed by the IRS. The tax practitioner didn't confirm that, and then 5 years down the road or 4 years down the road, the IRS sends the company a letter saying, where's your tax returns? This is a C Corp. And now the tax practitioner and the taxpayer, the owners of the company, are freaking out about what they should do. Okay, we're going to go over that next. All right, so confirm the entity type. Absolutely, very important to do this. This is a tax practitioner who posted a question in the representation group, and she had requested IRS transcripts for an S corporation, or so she thought. So she requests the IRS transcripts for an 1120S. That's the tax form that S corporations file, right? Just confirming, I got an account transcript. The return was not processed yet, most likely. Under form number on the transcript, it shows 1120 with no S. Oops, that's a really bad sign, folks. But the account transcript shows the extension was filed with an extension date of 9/15. So I am thinking if it is correct and just not processed yet. Am I also right that a 2019 1120S could not be e-filed this year? And so this tax practitioner actually had it wrong. If you're using professional tax software, you can file delinquent year returns for taxpayers as well as entities going back 3 years. So most tax professional software will do that. Will allow you to e-file delinquent returns up to 3 years in the past. If the return is more than 3 years late or more than 3 years delinquent, then that has to be mailed in. You can't e-file a return that's 6 years old if the taxpayer is that delinquent. Those returns have to be mailed in. But if you're using professional software and not consumer software like TurboTax or whatever, then you can go back up to 3 years. So this is a red flag. If you have an 1120S, so an S Corp return that was e-filed months ago, for example, and it's not showing up on the transcripts as being e-filed, then that's a sign that perhaps the IRS has never processed the Form 2553 and the IRS still thinks it's a C Corp. So if the IRS transcripts say 1120 instead of 1120S, that is a bad sign. I responded to this. That may mean that the 2553 was never processed, or it's still sitting in a pile somewhere. God forbid, like some giant pile of 2553s that aren't going to be processed for months and months. It's possible that the 2553 was never processed and that the returns have been deleted. And if you don't have a copy of the actual notice of acceptance, the only way to confirm the entity type would be to contact the IRS. So that's the only way that you confirm. And in this case, you got to make a call. So this tax practitioner, a different tax practitioner, said that there's a business specialty line number out there. And you can contact this business specialty line and ask if it's an 1120 or an 1120S, what kind of entity type the IRS is expecting. And that's the number that you would call. I always call practitioner priority line with a 2848 with a power of attorney in hand. And I just fax it to them when I'm on the phone and I ask them what's going on. So I get my answer when I call the practitioner priority line, but apparently there's a business specialty line that you can use as well. So in this case, if you do have a situation where, especially if it's the initial tax year, and you haven't received the notice of acceptance yet, that letter that we just went over, then you might have a problem like this, okay, where the taxpayer sends in an S Corp return thinking that it's going to be processed and everything is fine, and it might even be accepted, and you might get an acknowledgement back, but if the IRS doesn't recognize the entity type, then sometimes these returns basically get sent into a black hole on the IRS side. And that has been happening a lot more lately because the IRS is so backed up on processing. Like there's taxpayers who are waiting 6 months or more for the 2553 to even just be processed, even ones that go in on time, which is part of the reason why I said if you are sending in a late election and you know that it's late, then maybe the best way to send it in and looked at is to send it in with the tax return itself and send it in certified mail with the proper verbiage in red written on the top of the form as well as on the top of the return itself, and mail it all together in the same packet, certified mail. That way they can't ignore it. And that procedure is outlined in Revenue Procedure 21330. It tells you exactly what to do, what to write, and everything else. So the IRS tells you what to do in its actual guidance in the Revenue Procedure, which I have referenced in the previous slide. Now, another one, never received the notice of acceptance. So this is a slightly different scenario. This is a tax professional that did send in the Form 2553, but the IRS is so backed up that notice of acceptance was never received. So, hi all, happy tax season, which has not ended this year. I need to submit an S-Corp return which has not yet received the letter from the IRS. The notice of acceptance is what she's talking about. Is there a form letter anyone might share which should be attached to the return when e-filing? Thank you. And the answer is no. There's no form letter that you attach to the return. In this case, you're going to have to do a little bit of legwork. The first thing that I would do in this case is contact the IRS and ask if the 2553 had even been received, if it's in process. And she might be able to solve this over the phone, just like I did in the example that I showed you. It might be a situation where, oh yeah, it's been accepted, but we never sent you out the notice of acceptance, or it's on its way. Would you like me to fax you a copy of it now? And then you're golden. You're fine. You have the notice of acceptance. Everything is fine. You've solved it over the phone. It's great to be an enrolled practitioner. And that you could do that. So that would be my first step, is to contact the IRS directly by phone. That's the only way that you can do it. If you want to know if the 2553 is in process, you have to contact the IRS. If the 2553 was never received and it was never processed, then my suggestion in this case is to attach another 2553, treating it basically as a late election. And this tax practitioner, Lissa, her name is Lissa, said, that's what I was told by the IRS. So the IRS basically told her, gave her the advice, if the 2553 was never received by the IRS initially, or it was lost, or was never in process, or whatever, then what you do is you send in the 2553 with the return itself. And then, like I said, they can't ignore it then. All right, it's considered late, but like I said, the IRS is a dumpster fire right now, and there's tons of stories out there of the 2553 getting lost. The tax practitioner faxed it in and the IRS has no record of it, that sort of thing. So sometimes people are having to be sending these in twice. You fax it in once, you never hear anything from the IRS, it's just crickets. You contact the IRS says we never got it. Then the other option is to send it in and attach it to the initial return. And since it's never been processed, the IRS doesn't know that it's an S-Corp. So it's going to have to go in on paper. So paper file, this is my advice, paper file with the 2553 and do it certified mail, everything with wet signatures. This is always my go-to when the election is late, or even if it is on time and the IRS hasn't issued the notice of acceptance, where it's how it is like now, where you send in a form and you don't know if the IRS is processing it. You don't hear anything for months and months and months. So the IRS is losing a lot of paperwork right now. I'm just being real. And sometimes you're going to have to be doing things twice and sometimes even 3 times like this because your paperwork is getting lost. So it's the safest way, even though it takes a long time. I know that paper returns take forever to process. You're preaching to the choir here. But in this case, what else are you going to do? Okay, you've got to send in the 2553 and the return on paper. Because if you try to e-file the return, you're going to get a reject for incorrect entity type. And then follow up, make sure you get a notice of acceptance or the client might end up with a horror show down the road. So double check that 2019 was actually accepted and processed. This was actually a response to a different tax practitioner in the same thread. There are a lot of practitioner stories on the NATP group with that exact scenario where the return was accepted by the IRS e-file but dumped into a black hole because of incorrect entity type. So this is a horror story, and there are several like that on the NATP group as well as some of the other Facebook groups that I belong to, where the tax practitioner filed the 2553 and then just never checked back up on it to make sure that it was processed. If you don't have that notice of acceptance and you haven't seen it, you don't have it in your hot little hand, you've got to contact the IRS and make sure that the S Corp election is valid, that it has been processed. Okay? All right. Another scenario. IRS is saying the 2553 was never filed. Okay. I thought I sent a check the box form for a corporation to file as an S Corp. We did it. This is the form 2553. Sometimes they'll call that, tax practitioners will call that a check the box election or a check box election because you check a box on the form. All right. So when somebody says check box election, they're usually talking about this. So tax practitioner says, we did it. Did the IRS ever get it? This is about 5 years ago. Oh no! So this tax practitioner sent in the form 2553. She thinks they did. I thought I sent. Bad. Maybe she didn't do it. Either way, she never followed up. She never followed up on the notice of acceptance. This is horrible. This is horror story, because the implication is that this was 5 years ago. She's been filing S Corp returns for this entity, and it's been her client the whole time. And now she's got this huge dumpster fire on her hands. The IRS is saying that we didn't do it. And it says, if anybody has any tips on how to rectify this back to the date that we did do it, please PM me and bill me for the answer, provided that the answer is yes, this is solvable and here is how. So she wants a miracle, but that is not going to happen. That's not going to happen, probably. She's in trouble. She should have done this right from the get-go. So she thinks that she filed the 2553. Maybe she lost those records or she shredded them because this was 5 years ago. And she never followed up on the notice of acceptance. And now the IRS is sending letters to the client like, you're not an S Corp. Where's your C Corp returns? And now she's panicking. 5 years later. Are you talking about the form 2553? File it under late election relief. If that doesn't work, you'll need a PLR. Now, here's the problem. It's 5 years. The late election relief only works going back 3 years and 75 days in the past. That's as far as you can go back for late election relief. And she's saying this was a 5-year-old mistake. This is horrible, bad, which means she needs to call her errors and omissions insurance because there's possible lawsuit here. Okay. So even the late election, you can't go back 5 years. Even for late election relief, the 3 years, 3.5 years is as far as you can go back. So she's really made a huge mistake here. She never got the notice of acceptance. It says, I thought we sent the form. Does this mean she doesn't have a copy of it anymore? But this has been her client the whole time? This is bad. All right. So Frank Augustino, I left his name here because he's a very well-known tax attorney who belongs to this representation group. And he was the one on the, I talked about this in one of the other webinars. He was the one that represented the client in that kind of now famous passport revocation case, which was just decided in 2021. I think I'm saying this name wrong too, is Shitrit case. I'm not joking. It's SHITRIT or something like that versus Commissioner, where the taxpayer had a passport revocation and he was a victim of identity theft and he had to go all the way to the tax court to fix it. It was a really, really terrible case for the poor taxpayer. And Frank Augustino was actually the attorney who represented the client in that case. So he's very well known. He's a very well known tax attorney, very well known in tax circles. And he posted some exceptions to the 3-year and 75-day rule where there's for late election relief. And then he recommends one last point, do an FOIA request for the administrative file. This is a Freedom of Information Act request. And when you're an enrolled practitioner, you can do a Freedom of Information Act request. You can request the administrative file for either an individual or for an entity. It's not free. When you do a Freedom of Information Act request, there's only a certain number of pages that you can get free. And then after that amount, the IRS will start charging you per page. So it's not free. But in this case, then the tax practitioner can request a FYA for the administrative file. And then hopefully, if they get that, maybe there's a copy of the 2553 in there that says that the IRS did get it, and then it just wasn't processed correctly. And then in that case, the taxpayer would have like a leg to stand on. But this is a huge screw up. I'm just going to tell you right now, this is a huge screw up. So if you send in the 2553 for a client, you need to follow up on that sucker. You got to make sure that the notice of acceptance you get the notice of acceptance. You got to have that letter. You got to have that letter. All right. So do not let this happen to you. So this is 5 years have passed, and now the taxpayer is getting mail from the IRS that they're not an S Corp. And this tax practitioner is like, oh, please help me. If you can help me, just bill me for the answer because I need to fix this. But it would have been an easy fix if she had followed up on this 5 years ago when the 2553 was initially filed. But she didn't do that. You've got to have the notice of acceptance. Got to have the notice of acceptance. Absolutely. And if you do have any kind of inkling that the IRS, that it's not an S Corp, for example, you file an extension and you get a reject on the extension because of incorrect entity type, or you file a tax return and you get a reject because of incorrect entity type, those are all huge red flags. Huge red flags. You should not ignore it. You should not let it go and act like that didn't happen. All right, don't put your head in the sand. Call the IRS and find out what's going on. And if there's no notice of acceptance, you got to get a copy of it. Don't let this happen to you. All right, filling out a late election. So this is a question that was posed in one of the tax groups by a tax practitioner who is filling out a late election for the first time. And he had some questions, and I thought it would be good for you to see his questions because I think that these are really common questions when people fill out late elections for the first time. So this tax practitioner says, I just have 2 questions on filling out Form 2553. That's the S election form. First time doing a late election. This is for 2019. Or this tax practitioner actually posed this question in 2020. It wasn't that late, but it was still a late election. And he said, I understand everything else, including the eligibility and what goes on the form, except these 3 items. What is the date of incorporation? Is that the date the LLC was formed or the effective date of the S election? And on the form, the date of incorporation is the date that the entity was created on the state level. Whatever is on the articles of organization or the articles of incorporation, that is the date that you put there on the date of incorporation. It's the date that the entity was formed at the state level, the date that the Secretary of State stamped that those articles, right? That's the date you put. When filling out the reasonable cause section, is it okay to say something like, the shareholder and president were not aware of the need to file a timely S corporation election? And most of the time, when you're filing one of these forms late, it's just because the taxpayer doesn't know the process. They're not doing anything malicious. They don't know. They don't know that they have to do this. So he wants to know what he should put in the reasonable cause section because you have to put something there if it's a late election. And the tax practitioner said, you need to provide a reasonable cause as to why the form wasn't filed by March 15th, but you can just put something simple like due to misunderstanding of filing responsibilities, like the shareholder and the company president didn't understand the filing deadline. And that's reasonable cause enough. It says it in the Rev Proc. All right, I'm not making this up. It's in the Rev Proc. So you can't leave that section blank. You have to put in reasonable cause. But for a late election, the reasonable cause doesn't have to be like, I was dying, I had cancer, I was hit by a hurricane, something like that. It doesn't have to be anything crazy like that. You can just put, due to misunderstanding of filing responsibilities, the form was not sent in on time, and that's it. Okay, so you got to put something, but it doesn't have to be like, you were shot in the leg or dying in the hospital or something like that. Okay, reasonable cause can be just a misunderstanding of what you had to do. Question number 3. Since there was no prior entity classification made on Form 8832 by the client, should there be any statement to that effect on the Form 2553, or do I also need to file Form 8832 with the 2553? I am a bit confused on whether these two forms are needed. Thanks in advance. And once again, this is another tax practitioner that thinks that you have to file the 8832. You don't have to file both of these forms anymore. You haven't had to do that for the last 10 years. Some tax practitioners are still sending in both when it's an LLC, because that's what companies used to have to do. They used to have to file the 8832, convert to be treated as a corporation, and then again the 2553 to be treated as an S corporation. But you don't have to go through those steps anymore. If it's an LLC, you just have to follow the 2553. And then it goes without saying, if it's a corporation to begin with, not an LLC. Let's say it's a C corporation formed at the state level, and that C corporation wants to elect S status, then of course they only have to file the 2553 as well. They don't have to file the 8832. All right. Now, if you have an LLC at the state level, and that LLC wants to be treated as a C corporation for tax purposes, then the form that you file is the 8832, not the 2553. So you have an LLC, right? You have an LLC at the state level. You've formed your LLC. If you want the LLC to be treated as an S corp, you file the 2553. If you want the LLC to be treated as a C corp, then you file the 8832. And if you're sending in these forms late, all right, that election is supposed to be sent in right away. If it's sent in late, then there's a late election procedure if you want to elect to be a C corp, and there's also a late election procedure if you want to be treated as an S corp. If you're filing those elections late, it's a different revenue procedure. All right. Okay. So the 2553 is all that's needed. You need to make sure you add the statement under penalty of perjury with appropriate signatures. It has to be signed by the sole shareholder or by the shareholder, company president, or whatever. And then if it's a late election, you write filing pursuant to revenue procedure 2013-30 across the top of the first page. Put it at the top, and you fill out the late election section of the form. And then if you're sending it in with the first tax return on paper, once again, all of the signatures have to be original wet signatures. So a human being has to sign it with a pen. And you put filing pursuant to revenue procedure 2013 on top of the 2553. And if it's going in with the first tax return, which it can, you put that at the top of the tax return as well. In ink, right at the top of both. And like I said, this is all outlined in the Rev Proc if you want to sit down and read it. It's all in there. All right, S Corporation dumpster fire. So see my little dumpster fire at the top. This is a crazy dumpster fire. Nuts. This is one of the worst scenarios I've ever seen. So new business client has not filed since he started business in 2013. This is a chronic non-filer who has never filed an S Corp return back to 2013. He says he's an S Corp, but he has no paperwork to indicate that. The books are an absolute mess. We're working through that. Once we get the books in order and draft the returns, now the corp returns have to be filed, right? From 2013 to 2020. Where would you start in representing him and trying to lower the tax penalties? The penalties are going to be nuts. Thousands of dollars for every single year. Also, he says he filed his personal returns for those years, but without the Schedule K-1s. So he has his corporation, that he's formed, but he's never filed S Corp returns. He thinks he's an S Corp, but he has no notification of acceptance, and he has no paperwork, no 2553 to prove that. S Corp returns have never been filed. He filed his personal returns, probably on TurboTax or whatever, but how could he file his personal returns without the Schedule K1s? How did he do it? He did it wrong. He did it wrong. And they're all going to have to be amended because he had no Schedule K1s. So presumably the S corporation had pass-through income coming to him. So he said, his personal returns all need to be amended to 2013 to 2020. Tax practitioner says, please, no snarky comments about the client. He's the father of a large family, several kids with special needs, and under a lot of emotional pressure during this period. Not an excuse, just a fact. So go easy. My fees are taken care of, so there's no need to mention anything about getting paid up front. This tax practitioner posted this in a rep group. This would be a huge dumpster fire for someone to take on. I get stressed just reading this. I'm like, oh, I don't know how to deal with this stuff. But some tax practitioners really love this type of rep work. They love to untangle messes. I'm not like that. I don't like that. I would never take on a client like this. But some tax practitioners love this. And to be honest, if you get into rep work, there's several really good organizations out there once you become an enrolled agent that will teach you how to do this. We'll teach you how to solve these kinds of messes. He's looking for solutions on how to mitigate this, make it less dumpster fiery, less nightmarish, okay? So first thing recommended was while you fix the books, pull transcripts. Says, thanks, Amit. I'll probably do that, but the assumption is the transcripts are empty, no filings, and he generally does not receive any 1099s or other forms that would be reported to the IRS, but it is prudent to check to be sure. Thanks. One thing you will be able to discern from the transcripts is whether the 2553 was filed or not. So that's why you want to pull transcripts for this entity. So you have to contact practitioner priority line and say, I need to know what you have on file for this entity. If you have anything. So you contact practitioner priority line with a 2848, a power of attorney in hand, and say, what's going on? What entity type is this? What do you have on file for this person? Is it a C Corp? Is it an S Corp? Did you ever receive the 2553? That something has to show up on the transcripts. So you'll know if the 2553 was ever filed. That would show up on the transcripts. I always pull transcripts to be safe, and you never know what you will find, which is true. Taxpayers are wrong about a lot of things. They'll come to you and they don't remember what they did. And the taxpayer says, I didn't file, I've never filed. But it's possible that there's returns out there that he completely forgot about. I have taxpayers come to me where they say, yeah, I filed that return. And then I'll pull transcripts and there's nothing on file. And I'll have taxpayers that come to me and say, I don't remember what I filed. And I'll pull their transcripts and maybe they filed 1 year, they didn't file another. Taxpayers don't remember. They've told me the wrong answers all the time. Let's just say I can't even count on two fingers how many times taxpayers have told me one thing, and I'll pull transcripts and it's something completely different. Right, so got to pull transcripts. That's the starting point. This practitioner, Michelle, says, I would normally advise seeking late election relief, but since he hasn't filed as if it was an S Corp, I'm not sure if it qualifies. And it wouldn't. So if this person didn't file the 2553, the owner of this company, didn't file the 2553, then you wouldn't be able to request late election relief going this far back to 2013. You can't go that far back. The most you can go back is 3 years and 75 days. That's as far as you can go back to request late election relief. And in this case, the taxpayer, the owner of the company, thinks that the 2553 was sent in, but he doesn't remember and he doesn't have any record of it. So the tax practitioner, the author of the post, says he's incorporated and remembers filing the 2553, but his admin has scoured the office and can't find it. So who knows if it's floating out there, if it was ever received by the IRS or what. This practitioner says, I would start with a transcript analysis and confirm if it's an S Corp or not. Is it a Corp or an LLC? And the author says it's a corporation. So it's not an LLC. So what happens if it's an LLC? What's the default? If it's a single owner LLC, defaults to a sole prop. If it's a multi-owner LLC, an MMLLC, then the default is a partnership. But in this case, this person actually incorporated. So it's a corporation at the state level, which means if the 2553 was never received and processed by the IRS, then it's a C Corp by default. Now, this other tax practitioner, Eugene, says no notices from the IRS. So going back to 2013, the IRS hasn't come knocking yet. The author of the post says none. And Eugene replies, how does the IRS even know your client exists? And the author says the 941s and W-2s has been filed. So what ended up happening is this taxpayer formed this corporation, probably through one of those like LegalZoom websites or something like that, or Ink Paradise, like the website that I've used. They used an incorporator to form the entity, and they chose a corporation, so a C corporation at the state level. And then probably they were recommended as part of the checkout process. Do you want to, set up your payroll with QuickBooks or with Gusto? We'll give you a discount. Many of those websites, those incorporation websites, have partner programs with these payroll companies, ADP, those larger payroll companies, where you can set up your corporation and get set up in payroll, and they'll help you set it all up. So this taxpayer did that. He set up payroll, and he's been paying himself payroll. So the 941s and the W-2s have been filed every single year, but the corporate returns have never been filed, which is bad. Obviously, the IRS is going to catch up with him at some point, and the state as well, right? Depending on what state he's in. So this last tax practitioner gave some very good advice, I think, that it might be cheaper in the long run to file as a C Corp. And I totally agree in this case. If there's no 2553 floating out there, it might be best to kind of let sleeping dogs lie and file as a C Corp. Now, let me tell you why. If you file as a C Corp, then the C Corp penalties only apply to the amount due. There's no late filing penalties unless the corporation actually has taxable income for that year. So if he has been paying himself a payroll and he says he has an admin, maybe when you crunch the numbers for the C Corp, if they're paying payroll, there might be very little income or almost no income, or maybe there's even years where he has losses, like a loss for the business for the year in the books. So once the books get cleaned up, and you pick up all the expenses that the corporation is actually eligible to take, then there's a possibility that there's losses or very little income. And then that C Corp won't be liable for these huge late filing penalties for failure to file the return late and failure to file Schedule K-1s. Because when it's a C Corp, the penalties only apply to the amount due. So the only penalties would be on the balance due by the corporation, and those can be dealt with. That's just a thought. So I agree. You gotta go through and do the books and find out what's actually going on and pull transcripts and find out if it's an S Corp. But this kind of a situation, sometimes it's actually better for it to be a C Corp. And either way, no matter what happens in this case, I think when you have a gigantic dumpster fire like this, where it's like 6 or 7 years of unfiled corporate returns, I think those corporate returns should all be filed. And then at the end of that situation, the corporation should probably be dissolved. That's always my recommendation when you have a huge dumpster fire. Because at least with S corporations, those late filing penalties stay with the S Corp. And then if the S Corp is dissolved, then those late filing penalties stay within the S Corporation. All right. Now, if it's payroll tax, TFRP, so trust fund recovery, that trust fund, if it's payroll tax that's due or payroll tax that's delinquent, absolutely the IRS can go after the shareholders of the corporation. That's not what I'm talking about here. If you have late filing penalties, like for late filing of Schedule K-1s, then those penalties actually stay with the S corporation. And if the S corporation has no assets, like it's insolvent, then usually it's better to just dissolve and start fresh with a different entity, or maybe even just as a sole prop going forward. So these are all things to consider, but this is a huge dumpster fire here. So multiple years of unfiled returns. The taxpayer doesn't even know what entity type it is, but the IRS absolutely knows that the entity exists because he's been filing payroll the whole time, but he's never filed entity tax returns. All right? Okay. All right. Now, the last slide is a question that we hear from tax practitioners all the time, and that is why you shouldn't hold real estate in a corporation, either an S Corp or a C Corp. It's a very bad idea. Now, people always want to know why that is, and many times newer tax practitioners, they don't understand why you should never hold real estate in a corporation, and that's either an S Corp or a C Corp. Now, before I get into this, I want you to understand that I'm talking about small companies here. Of course, if you're talking about a gigantic multinational corporation like Ford or Coke or Apple or Google, those are huge companies. All of those corporations own real estate. It would be absurd if they didn't, right? So these huge companies, they have factory buildings and they have office buildings that they operate out of. And these companies are enormous. So of course they own real estate. And the corporations themselves own that real estate. Okay, I understand that. But when we're talking about why you should never hold real estate in a corporation, either an S Corp or a C Corp, usually this is advice that we give to smaller companies. So if it's a husband and wife corporation or just a single shareholder S Corp, it's generally a very bad idea to hold real estate in a corporation. So this tax practitioner was kind of a newer tax practitioner, and he posted this question in this group. This is a great group to join, by the way, Schedule E rentals and real estate taxation for tax professionals. Have to be a tax pro. But this tax practitioner asked, S Corp versus LLC for rental properties, this is sole owner, first purchase, which one is better? And Jason, one of the tax practitioners in the group, said no real estate in S Corps. And he got like 21 thumbs ups because it says you should never keep real estate in a corporation. Most of the time, it's a very bad idea. Now, there's some exceptions to that rule. If you have a situation where the corporation has real estate, but the real estate itself is inventory. So if you have a real estate developer, or if you have someone who's doing house flipping, then that's okay. And it's actually a smart idea because the real estate is inventory. It's inventory. It would be just like, if you owned a grocery store and the inventory you had in the grocery store, or, dog food store, it's like treated the same as the dog food in the dog food store. It's not a capital asset to the company. If it's a company where the real estate is inventory, like a house flipper or a developer, like a person who's building homes and selling them to the public, then that's okay because the real estate is just inventory and all of the income is ordinary income anyway. But if the real estate is a capital asset, then it's usually a mistake. So this tax practitioner said, I'm pretty sure it's a verse in the Bible, thou shalt not hold thy real estate in an S Corp. With tax practitioners, we can have a sense of humor too, right? So they're all joking about this because that commandment is right below. Putting real estate in a C Corp is separating the stockholders from their money permanently. And this other tax pro, this is Heather. This is not the same one that asked the question because a lot of tax practitioners don't know this, at least at the beginning of their careers. She asked, why shouldn't rental properties be held in an S Corp? Just curious so I can advise clients. And this tax practitioner had the right answer. She said, real estate is assumed to be appreciating property. I know that real estate can lose value. Sometimes that happens. But most of the time, real estate goes up in value over time. If you hold onto a building or a rental property or a piece of land long enough, it's going to appreciate in value over time. Now, there are times when real estate can lose value. I know that happens. But most of the time, real estate is an appreciating capital asset, which means it's going to be worth more as time goes on. Unlike most other assets within the corporation. Like if you own a computer and it's a business asset, That computer is not going to be worth more in the future. It's going to be worth less, right? Your computer equipment doesn't go up in value. It goes down in value. You buy it and it's worth less over time. That computer is worth less and less. Same thing with like a business vehicle, right? So you buy a van or a delivery truck or a semi truck or whatever. Those assets lose value generally over time. They're worth less. Real estate is the opposite of that. You buy real estate and most of the time, if you hold on to it, it's worth more. That's where the problem comes in. Now, an S Corp, as well as a C Corp, when an S Corp or a C Corp distributes property, they're corporations, they have to distribute property at the fair market value. They cannot distribute property at the property's basis. That's why a partnership or a sole prop, an individual taxpayer holding the real estate directly, is always preferable. Always. And many times you will have businesses where they will have an S Corp for the business activity, and then they will have a disregarded LLC to hold the building that the corporation does business out of. They will not purchase the building through the S Corp or through the C Corp in order to avoid this problem. Because if you distribute real estate or any other type of asset from an S corporation or a C corporation, it's a taxable event. The distribution is done at fair market value, whatever the fair market value of the property is, and not at the property's basis. That's not the same thing with partnership or with, a sole prop. So if you have a partnership and the partnership owns a building and then the building is distributed to one of the partners, then it's distributed at the asset's basis. Whatever the basis is within the partnership, it retains the same basis in the hands of the partner. And that's not a taxable event, that distribution. But if it's a situation where it's an S Corp and the S Corp or the C Corp owns the building, and then the building is distributed, but the basis in the fair market that's gone up in value, right? The building has been held, for example, for 10 years or whatever, and now the building is worth $100,000 more, then it's treated as a sale. It's treated as a sale. It has to be distributed at fair market value. It becomes a taxable event. So that's what you want to avoid. You don't want to do that. Now, sometimes you'll have a client that comes to you and they have real estate in a corporation and it's been in the corporation for years, and that's it. You leave it in the corporation and you just deal with what you have. All right. So sometimes you'll have a client that comes to you and they already have their real estate in a corp, and generally you just leave it that way and go on. But you don't want to ever advise a client to do this, to put real estate in a corporation, unless there's a significant legal reason to do so. So, sometimes there might be a legal purpose for putting a real estate into a corporation. Like maybe you do have a corporation that's getting big and it's going to be publicly traded or it's going to franchise out like a restaurant chain or something like that. And then in that case, then yeah, that corporation is probably going to end up owning real estate, and they're going to own like those multiple stores. They're going to be corporate owned or whatever. That can happen. But if you're talking about a small company, husband and wife or a single shareholder, you generally don't want to put real estate in a corporation. You want to form a separate LLC or just have that real estate owned personally by the taxpayer and not owned by the corporation. All right. Generally, you want to avoid that because of this situation or this scenario. Because if that real estate later gets distributed, that distribution is a taxable event. And then this last tax practitioner made another good point, that in addition, an S Corp requires a salary. S Corp shareholders have to pay a reasonable wage. You got to do that with an S Corp, where an LLC does not. So you're basically creating a situation where you're going to have payroll tax when you wouldn't have to if it was just a sole proprietorship or a partnership. So if you can imagine the scenario, let's say you have a situation where it's a partnership and the partnership owns like 5 rental buildings or 5 apartment complexes or something like that, then all of that income that comes into the partnership is all rental income. There's no self-employment tax. It's all passive. So you're not going to be paying self-employment tax on that income. But let's say you put those rentals into a S corporation, then all of a sudden you have a situation where you have to pay wages, and then you're paying payroll tax on the wages when the rental income would have been, number one, not subject to SE tax. And then all of a sudden you have like all of these shareholder restrictions where the income can't be, distributed in a flexible manner, which partnership will allow you to do. And then you have to start paying salaries where with a partnership, you don't have to pay salary to the partners. The partners are not employed by a partnership, so you don't have to pay wages to partners. So partnership as an entity type is much, much more preferred to hold real estate, especially rental properties, because the rental income retains its character and there's no SE tax. You don't have to pay salary. You don't have to pay wages. You don't have to run a payroll. But once you put those rental properties or those properties into an S corp, then you all of a sudden now you have to run a payroll. The shareholder's paying payroll tax. You don't have flexible allocations. You can't be flexible with how the money flows out. And then once you do finally distribute that real estate to the shareholder, it has to be distributed fair market value. It becomes a taxable event. But if it's a partnership, then and you distribute a building or one of the rental properties to one of the partners, then it just gets distributed at whatever the basis of the property is in the hands of the partnership. It's not a taxable event at that point. The only time it does become taxable for the partner is when they later sell it. So they could potentially hold that building for years and years and never sell it. And it never becomes, it's not a taxable event when you distribute property to a partner from a partnership. Generally. All right, I'm not going to say never, because there's times when it's treated like a deemed sale or something like that. But in general, much better to be holding real estate in a partnership or a sole proprietorship, holding the real estate directly by the sole prop than holding it in either a C Corp or an S Corp. You generally want to avoid that, okay? And there's exceptions to every rule, but that's the general rule. No real estate in an S Corp. Okay, got it? Okay. So this last slide just has a link to a website, which I think is a good resource. This website is a certified public accountant, but this particular CPA is an author of a book on Amazon about LLCs and S Corps, which I've read. It's actually not bad. It's written for the general public, so it's easy to understand, and it has like tips and tricks on when you should be an S Corp and when not, and the differences between an LLC and an S Corp. And I read the book and it was good. It's not expensive. I think it's $20 or something like that on Amazon by this author. And he talks about how to file late elections on this website. This website has a lot of downloadable forms, which are really useful. And I'm showing you this because he actually has his fees listed here. And he shows what he charges. And I know that many times tax professionals are curious about what other tax professionals charge. So this is here, and you can look at it. Like I said, there's a lot of good resources on this website that are public. This is all open for the public to see. Like I said, this guy wrote a book on Amazon, which is actually pretty good. Usually I recommend Nolo Press, Nolo, but Nolo Press doesn't have a book that's just, they're a legal publisher, which is very reputable, and they have fantastic books out there about how to form LLCs and, books on how to fight the IRS and how to go through the audit process and everything else. I recommend their books, the books by Nolo Press, but Nolo Press doesn't have a book that's specific for S corporations only, and this guy does. So you can look for it on Amazon, but he shows what his fees are and what the process is. And he tells you what he does in his process to file a late election, how much it costs, how much to open payroll. So he sets up the entity's payroll for you as well as filing the late election. And then he actually admits right on his website that if he can't get payroll set up on time, he'll issue a 1099 for officer compensation for the first year. if you miss the payroll deadline in lieu of a late payroll, and he charges $650 for that. So this is I don't do this, and I've talked with Tom Gorzinski, who's the other co-author of the Passkey books, and he doesn't do this either. I don't. If I can't get payroll filed on time for an entity, I don't do the 1099 thing because that's a kludge and that's incorrect. But sometimes tax practitioners will do this because they feel like it will appease the IRS if they come in and audit the corporation later. I don't personally do this because this is a misclassification issue. And at least in California, this can get you in big trouble because a 1099 is something that you issue to a independent contractor. And in California especially is extremely aggressive, their EDD. And if it's a company where they should be paying wages, California wants their SDI. That's the state disability insurance that every single employer is required to pay. And that includes shareholders of an S corporation. So I don't do this because I'm afraid of the legal repercussions, but this particular CPA will do this, apparently, says it right on his website, that if they can't get payroll set up in time, they'll do a 1099 miscellaneous as officer compensation in lieu of the late payroll. And I have worked for firms that did this, but only for the first year. So they'll only do it, as a kludge for the first year, and then that S corp has to get on payroll with them. Otherwise, they basically fire the client. They're not going to have an S corporation as a client that doesn't run payroll, and that's my belief too. That's my feeling. So, but this is all here so you can see, and then the S corporation tax return, what this particular CPA charges is $1,000 to $1,200, which is actually pretty reasonable. I feel like this is kind of high for the 2553, but I feel like this is on the low side for the fees. The last firm that I worked for charged double this minimum, basically. So just so you can see, what this particular CPA charges and what his process is, and he talks about the late election and what to do. And as you can see, there's all kinds of information here on this website. This is a great resource if you want to go look at it, and the link is on your slides. And that's the end of the S Corporation Deep Dive. So check back soon for more bonus videos. All right.